अब मैं देखूं साफ बारिश के बाद हट गई रुकावटें राहों से आज ओ अंधेरा दूर हुआ हुई नजरें साफ जीत का विश्वास हर दिन साफ जीत का विश्वास हर दिन साफ
श्रीराम ट्रांसपोर्ट फाइनेंस, जैसी आपकी जरूरतें वैसी हमारी फाइनेंस सेवाएं।
मंजिल मिली है जिसकी थी तलाश जीत का विश्वास हर दिन साफ
श्रीराम ट्रांसपोर्ट फाइनेंस, विश्वास जीत का।
Good afternoon, everyone. Welcome to the ICC Banking Summit 2021. The Indian Chamber of Commerce is a premier body of business and industry in India, set up in 1925 by a group of pioneering industrialists. The chamber has been functioning efficiently in building meaningful synergies among the industry and the government by addressing strategic issues of national significance. It has been instrumental in facilitating better commerce within the country. Over the last few years, we have seen a dramatic change in the banking industry and the way the customers are transacting, especially since we were hit by the pandemic. Perhaps with the fear of lurking coronavirus, physical exchange of monies has given way to increased digital transactions and online banking activities. But this is just the tip of the iceberg. There are a lot of other dynamic actions which has taken place as we slowly and steadily inch into normalcy. The ICC Banking Summit focuses on what has happened in the last 2 years in India and globally, and what, according to our experts from the industry, is going to be the new normal in the banking sector as we move from the stage of pandemic to endemic. May I request Mr. Ameya Prabhu, Chairman ICC Western Region and Partner UAP Advisors, to begin with a welcome note.
Thank you, Ratish, and good afternoon to everyone, and welcome to our annual ICC Banking Summit. It is a great pleasure personally of mine and an honor that I am chairing this year's summit as in my capacity as the Western Region Chairperson. And while we cannot have the summit in person this year, this is of course a flagship program of the Indian Chamber of Commerce in the Western Region. I'm certain that as we conquer the pandemic and as we move beyond the pandemic, with the rising rates of vaccination in India, I'm certain that we will be back in person next year, see all of you in person next year, and we'll go from strength to strength. So thank you so much for attending, and thank you to all of our sponsors, to Shriram Transport, to Suryodaya, to BCT Digital, and of course to Mr. Setti and Mr. Revankar, and of course Mr. Subramaniam, who will be speaking later to attend this initial session. Of course, I think just a few remarks on my behalf. At the Indian Chamber of Commerce, we are very keen that we we remain at the cutting edge of what is going on in the banking and insurance sectors, and also in the finance sector, so that all of our members, all of our attendees are well versed with the ongoing changes. As someone once told me, that unless you evolve and adapt, you remain a dinosaur and die. So I think banking is one of those industries which is going through a massive transition, and I think it's something which will completely, be different. My father used to be a chairman of a bank back in the day when he was probably my age, actually younger than me, Saraswat Bank. And I remember him and I having a discussion recently wherein he said that in their days, whenever they opened a branch, the branch manager was a very powerful person. And, especially if they opened it in a Hubli or in some of the, and you needed so many people to open a branch. And today it's all digital. I mean, everything that you do, I, to be honest, can't remember the last time I went into a bank branch, and banking is done so seamlessly, so beautifully. And even, I must commend that, people usually say that PSU means slow or laggard, but I think SBI has shown us that probably SBI is, and I must also have the opportunity that Mr. Setti is here. I must also commend them that probably the best digital systems today is SBI. We think that HDFC is better. I'm a user of HDFC, and I must tell you that SBI is far, far better. And I think in time to come, the market capitalization of the banks will also start reflecting that. So I think one point which I would like to really focus on is that as digitization grows, as we keep going in, there was an article I was reading just before, ironically, this event by Bloomberg about how Google getting into payments is actually going to also affect retail banking, and how is that going to affect the, let's say, non-traditional players coming in. So of course, the way I see it is there are two elements to any business. One is knowledge and one is information. So while the Googles of the world can capture the information, our traditional banking and NBFC systems such as SBI, Shriram have the knowledge. So if we can actually get the best in practice technology, which we are already doing, I see no reason why the next transition that happens in banking, that happens in lending, that happens in payments will eventually be won over by our own domestic giants, who hopefully one day will become international giants. So it's a time of great transition. It's a time of great change. We've all gone through the pandemic. We've all gone through the at least in urban India, more and more people are paying digitally, and of course that also brings in other challenges. And in terms of how to manage the both of our the float, but of course in the future we see more changes coming in through blockchain, coming into the system, and maybe that can be used as a method to reduce fraud through the verification process. So it's going to constantly be evolving. I'm sure when we meet a year later, there'll be greater change, greater disruption, and we'll be discussing that. But I think one thing there's for certain, that our large institutions, I'm sure, will be here today. They were here yesterday and will be there tomorrow. Their institutions are above and beyond any of us individuals. And I think we as ICC, of course, again being one of the oldest chambers of India, will always be at hand to ensure that the best in practice thought processes, best in practice knowledge in this banking sector is conveyed to our members, and we bring in some of the leading light luminaries of the industry to speak. So thank you so much, everyone. And of course, before further ado, I will request our honorable speakers to speak. So I will request at the beginning Mr. Challa Srinivaslu Setti, who is the Managing Director of Retail and Digital Banking of SBI, the person who I must say, give a lot of credit to for all the SBI's innovations in this space. So thank you so much, sir, as a SBI customer as well. Thank you, and also as an Indian. So I'll hand it over to you. Thank you so much, sir.
Thank you, Amay, and good afternoon, ladies and gentlemen, who is there on this call. And I must, to start with, thank Indian Chamber of Commerce to give me this opportunity to share a few thoughts on what has been the impact of pandemic. I don't call it post-pandemic banking. I think that's a topic which is given to me, but I would like to dwell upon what has been tectonic changes which have brought in the banking, the way we do with banking, the way we conduct banking, and how is that the banks have to prepare themselves to the so-called post-pandemic world, if ever there is one. I don't think we would ever able to say that there would be a post-pandemic world. It's an optimism, yes. Obviously, we'll have to look forward to that. I just would like to give some introduction what we have done during the pandemic period, and subsequently I would like to talk about 4 items just to bring some clarity to my thoughts. One is how the banks were able to focus on asset quality and capital adequacy, how they have adopted to the rapid digital technology, and what could be the new business avenues and competition from what Mr. Amay Prabhu had mentioned in terms of big tech players or new technology players, or so-called non-traditional players. And finally, how banks can thrive and position themselves for the long run. I think these are a few thoughts which I would quickly share. I know that there's a limited time. So during this pandemic, I think I must confess that in my 32 years of banking experience, I'm sure like me, many other bankers would have never faced any such situation. It's kind of unprecedented, once in a century kind of event. None of us was really prepared, and it has the lockdowns, the infections, the mortalities, every situation has impacted every part of the world. And the economies went for a tailspin. And of course, banking, which is an integral part of the economy, is not spared. In Indian context, in several countries, of course, the regulators, the central banks, the governments have taken many initiatives. From an Indian context, I think the concerted effort of the government, the regulator, the borrowers, the banks, customers, I think the whole ecosystem worked in a very collaborative and coordinated manner to ensure that sufficient liquidity is available in the market. There are measures in the form of restructuring of loans or the moratoriums which are given to the borrowers. And the additional financing which is given, both guaranteed loans by the government and also COVID emergency loans by the banks, have ensured that the impact is lessened. I'm not saying that impact is removed. It is a huge economic impact this COVID had. And to a certain extent, I think it's been fairly handled by all the stakeholders in the economic system. And more importantly, I think we must appreciate the efforts of the banks and the financial services companies to ensure that the service disruption is minimized. I've never heard the banking system or the bank branches not being opened or ATMs not working, or the digital channels not functioning. So to that extent, I must say that the banking system has acquitted itself very well. And I'm proud that by having 24% margin, 24% market share in the banking industry, State Bank of India has been in the forefront of this effort to ensure that the financial services are continuously provided to the customers. So coming to the thoughts which I have, want to share with you is the first and foremost concern when the pandemic hit, the lockdowns were national in nature in the first wave, were the concerns relating to the asset quality and the consequent capital adequacy which the banks are likely to face. And I think there are several scenarios which have been played out. What could be the baseline scenario? What could be the extreme stress scenario? But thankfully, 2-3 things have helped the banks to weather the storm. One is, even before pandemic, most of the banks have worked to clean up their balance sheets. The twin balance sheet problem, which we've been talking for almost 5 to 6 years prior to pandemic, have been largely addressed. There have been corporate defaults, but which have been taken care of by the robust provisioning which the banks have done. And the corporate themselves actually deleveraged to a large extent. Some of the corporates which could not sustain have gone into insolvency. Broadly, what happened is that the cleanup at the corporate banking, corporate level, as well as the corporate books of the banks, has helped them to ensure that the storm is handled in a better manner. For instance, because of the robust provisioning which has been happening over the years, most of the banks pre-COVID also had a PCR levels as high as 80 to 90%. That means whatever little stress which we have witnessed in the retail book in the first wave could be handled in a better manner because the corporate book was already handled by way of robust provisioning. So the retail portfolio definitely has taken a hit both in the first wave and in the second wave. But what we witnessed is that large number of borrowers have tried to maintain their credit worthiness, credit scores, service to the extent possible, and have not opted to a large number of restructuring. So that had ensured that the asset quality concerns which have been expressed in the initial stages have not been, as big a concern, as we thought. The second wave definitely had created much bigger problem because the second wave had been impacted both urban and rural areas alike, and there have been a large number of mortalities. So that has, to a certain extent, had some impact on the absence of moratorium had resulted in some spike in the stress in the retail book. But still, I don't see that it's a matter of concern from the kind of very serious concern in terms of the asset quality. So far, even the Q1 numbers indicate that most of the banks have reasonably acquitted themselves. It is also evident from the positive trend in the return on assets and return on capital, return on equity, which the many banks have reported, shows that across the banking sector, to a large extent, God forbid there is no third wave, I think the banks are in a position to weather the storm and the asset quality front. The capital adequacy ratios, there were several stress scenarios what RBI has presented. There will be some temporary impact on the capital adequacies, but I don't think there would be a great concern in terms of maintaining the minimum capital common equity ratios. Most of the banks are able to raise new capital. 81 bonds, what you have seen, State Bank of India was able to raise at a very, very attractive price. It shows that the capital raising going forward may not be an issue for the banks. So on the asset quality and capital adequacy front, my assessment and obviously the hope is that the way forward for the banks would be that you continue to create the buffers and a robust and a proactive provisioning on the possible impact on the asset quality would be quite helpful for the banks to withstand any possible continuation of the pandemic situation going forward. But this pandemic also had created several opportunities. The opportunity which was quite evident was how the rapid technology, digital technology in particular, has been adopted both by the banks as well as its customers. I think, again, I may be mentioning in terms of the ability of the banks to provide technology solutions has been immense. And again, I take pride that State Bank of India, for several years, have been actively investing both in the capital expenditure of technology and also the operational expenditure. We were also pioneer in bringing the mobile banking in a big way to the masses. That had helped us to a situation where unprecedented business disruption cost. How do you deliver banking services in virtually no physical contact? I think that was the biggest challenge. While we opened the branches, our ATM networks were operating. When the customers were not able to physically come, we were seamlessly able to deliver the banking services, both because our digital channels were robust. And more importantly, India had tremendously moved on the digital payment space. The UPI rails and NPCI network, which we have created, and the way we adopted to the digital payment services has ensured that none of the common man, none of the bank customers have been impacted during the pandemic. And a great amount of adoption which had happened. And another thing is that the pandemic also has been, as I said, a catalyst to digital adoption. It was also a litmus test for the digital infrastructure, banking infrastructure. And it has also been a litmus test for our business continuity plans, which were never tested in such an extreme manner. Like, for example, we operate our global IT center from Belapur, and not for a day that the IT network was ever impacted. And despite almost 90% of our workforce not coming to the IT center, we were able to operate our global IT center by adopting work from anywhere and work from home. I think this has put a tremendous test on our business continuity plans. I'm sure several banks have learned quite a few things in this. So what we have to now learn is, how do you embed this agility and the digital capability, what we learned during this period, into our business philosophy is something which banks have to take it forward. And of course, there are new business avenues. And again, I quote from Amay's opening remarks, in terms of competition coming from non-traditional player, big tech players, the Google Pay bringing the fixed deposit on its platform. So these all provide both a challenge and an opportunity. And a challenge in the sense that the big tech have their own, I mean, the scale is not a limitation for them. The technology is not a limitation for them. And they don't have any legacy issues to handle. So obviously they will offer extreme challenge to us for the incumbent players. But incumbent players have 2-3 things which go well for them. One is, of course, the trust which the customers have in us and our ability to hyper-personalize our services. I think these 2-3 things which we have to leverage. And of course, you need to have your technology robust way. While those banks which have invested in the past few years have definitely got benefited during the pandemic, even those laggards can, if they get the technology planned properly, can use much more cutting edge technology which is currently available without being bothered about the legacy system. They can also give the competition because the customers trust us. I think we don't have to really worry about non-traditional players unless, of course, we get it right on the customer service point and the technology point. And maybe, sometimes we may have to collaborate with the big techs in order to ensure that we stay in the business and survive in the business. The other part which the new business avenues, what I'm talking about is the retail banking essentially will move to the digital space. What happens to the corporate banking? And in terms of retail banking, I think one more element which we must keep in mind is the rapid ascension of the fintechs. Today, fintechs are able to provide not only the P2P lending, they are into blockchain, they are into so many aspects where the disintermediation of the banks is effectively going to happen. So while they lack the scale, they have the ability to reinvent very fast. So can we not collaborate with them? It's not only about competing. I think a great scope exists for collaboration with fintechs, especially in the technological areas like blockchain, areas like the P2P lending. So I think there are quite a few opportunities in fintech. For example, in State Bank of India, we are not only looking engagement with the fintechs in the payment space and the lending space, we are moving even to agri-tech, agri-financing in a big way. How do we collaborate with agri-fintechs to reach out the rural customers in a more digital and efficient manner? So in the corporate banking space, I think pre-pandemic, the corporate strategy always has been, how do you achieve the operational efficiency? But the post-pandemic, most of the corporates started thinking about how do you manage the operational risk? How do you manage uninterrupted cash flow management, end-to-end cash and digital cash management? How do you manage your supply chains? And how do you manage your supply chain financing, the dealer financing, vendor financing in a very seamless manner? So the bank should be in a position to take care of these requirements. Otherwise, the corporates start thinking or maybe start moving towards, the fintechs which can provide these services or the banks which can provide. And I definitely recommend that we all have to work in terms of providing this seamless corporate banking services in this particular space, that is payments and receipts and the supply chain management, particularly supply chain financing. Then the other areas which we definitely look with a huge digital adoption which is happening in the rural areas. Even in this pandemic period, the rural sector has reasonably done well. I see a good amount of growth in the farm sector. The farm household incomes are increasing. Their propensity to spend is increasing. And a lot of farmers have a formal credit history now. So how do we design our products to reach out to them? How do we, I told in the newspapers today also that, how do I make a pre-approved loan to a farmer? I think the traditional areas have a non-traditional opportunities throwing up because of the digital adoption across the country. I think the banks have to utilize this in the post-pandemic era. And how banks can thrive. how do you position yourself in the long term? As I said, all these learnings, what we have had in the digital space in terms of business continuity, we have to embed in our policies, in our products, in our processes. Today, I can't think of launching any product and process without thinking, how do I make this product to reach digitally to my customers? I think this is the paradigm shift which the bank managements have to adopt in their thinking and visualize, what is likely to happen going forward in the ecosystem and be ready for that. And we also have to position ourselves the new thinking which is emerging. It is what we call it is not only the end of creation of value to our stakeholders. What is the purpose of the banking itself? What we call the so-called philosophy of purpose. Today, I think there is a greater amount of expectation from all the stakeholders, how banks position themselves in terms of the environment, sustainability, and governance goals. How do they create value? How do they create, help the societal and community to create income levels, improvement in the income levels? How do you remove the equality, both inequalities in gender, inequalities geographically? I think we have a greater role, societal purpose. There's a sense of purpose what we have been probably performing over the years, particularly public sector banks. But I think we have to redesign and re-articulate the purpose of the banks in terms of embedding our values into the values of larger societal goals. Whatever you call it, whether you call it ESG, whether you want to call it community action oriented, I think the sense of purpose has to be brought into our operations. So in conclusion, I would like to only state that the pandemic has taught us lessons. And to a large extent, we have acquitted ourselves very well. But this journey is not a journey which can be stopped now. We have to improvise, improve, adopt to the new emerging challenges, and also the challenges which we've been facing so far in the years. And focus on the customer service, focus on the educating our customers for emerging technology. When you are pushing too much of a digital adoption, we have to ensure that the customers use these channels in a safe, secure, and easy manner. And there is a greater responsibility on the banks to make our customers to adopt to these digital technologies so that they are empowered and encouraged large number of bottom of the pyramid people to come and use these channels. I think that fulfills both the business purpose and the larger goal of serving the community. I once again thank ICC for giving me this opportunity. I hope I was able to share my thoughts in a proper manner. But I think there's no limitation of this topic. We can go on and on. But I must compliment ICC for organizing this timely event. And I wish the rest of the sessions all the best. Thank you very much.
Thank you so much, sir, for taking the time out. And also, would you have time for a couple of questions that, or depending on your schedule?
Sure.
Yeah. So just, I mean, one or two things which I wanted to, how do you see, I mean, with blockchain coming in, I mean, and it's especially on the, I mean, you're looking at both retail and digital. So I think blockchain is bang in the middle of your ecosystem. So how do you see one can integrate a newer technology such as blockchain, especially when it comes to fraud prevention and also, I mean, fraud prevention on both sides, both from a banking perspective as well as from a customer perspective. So how do you think we can integrate such technologies into the traditional banking spectrum?
I think in terms of blockchain, there are three major use cases, I think, where banks are working on. One is, of course, on the trade finance. Trade finance is the most amenable activity for blockchain. There is a team of bankers under the IBA are working on how do we for the banking system, instead of actually individual banks work on it. Blockchain technology for the trade finance is one area. And as you mentioned, of course, blockchain can also be effectively used as a fraud prevention, transaction monitoring. Number three, which is a very interesting use case, which we are in SBI working. For instance, we have a product which we are hopefully will launch in the next 6 months. It has taken a little delay because of the pandemic. Is a product called Safal, where we are working with an organic cotton farming community. In this, there is an Italian company which is procuring this organic cotton, and the farmers are identified by a company here. So the buyer would be interested in knowing that what inputs are going into it, because it has to be truly organic. So the whole input management, crop growth, crop production is being monitored blockchain. Then what we are doing as a financier is that we will enter there, and I know that the blockchain is helping me to monitor which farmer is growing how much of cotton, what is the acreage, what is the cost of cultivation, and I provide the financing to the farmers. And I also have the ability to collect that loan because there is a buyer who is buying this, and then the money actually flows into the bank account. So this kind of use cases are immense in blockchain. The only thing is that I think because it is a complex technology, the adoption levels are taking time. The future, particularly in terms of trade finance, in terms of community financing, the blockchain is going to play a very important role.
Very well said, sir. I think on community financing, and just that actually leads me to my second question. In terms of so the RBI last year also gave out these. I mean, not last year, a few years ago, also started creating the framework for this P2P lending. The peer-to-peer lending. To create these platforms. And initially, they were quite big in the US. With Lending Club and Lending Cart, some of these companies. And in a way, P2P lending is also a very cultural thing in India. I mean, if you look at the informal sector, a lot of P2P lending has always happened, and of course there are negatives of it in terms of ability to assess credit risk, collection, also looking upon, and that's where the security of a bank comes in, because but of course the flip side is banks do have higher admin costs that do come in terms of going through a bank. So going forward, how do you see banks change? In terms of, because anyway, I briefly alluded to the fact that when my father was a banker back maybe 30 years ago, no, yeah, maybe 30 years ago, yeah, actually, exactly 30 odd plus years ago. When and in terms of how the and of course now even since then we've seen so many changes happening. Where do you see next 30 years? You think banks will? I mean, this is a bit of a radical question, but do you think banks' relevance will go down? Will banks evolve? Maybe banks may not do lending, but maybe banks will do something else. And of course, banks have been around for 500 years, but it's with the advent of the banks in Florence and Venice. So just more of a academic philosophical question. How do you see this emerge in the next 25, 30 years?
First of all, Amay, I think 25, 30 years is a very long horizon. The way things are rapidly changing. So, but I think for the last 4 or 5 years, what we've been hearing is that banking is going to happen everywhere other than banks. I think that is the usual refrain which I hear that, and which we are visualizing also. That is, I'll just give an example. 93% of the banking transaction in SBI happen outside the branches. 93%. Despite that, you may see a large number of people still visiting the branches. So I keep telling that if I have not had the digital and the alternate channels, my branch network would have collapsed by this time, because there has been an explosion of small value transaction on the UPI rails. So those transactions, at least part of it, if it had moved to the branches, I don't think branches would have been able to handle. So the banking and the branches probably would be reinvented in itself. I don't want to hazard a guess what happens after 15, 20 years. But the next 5 to 10 years, I think the reinvention of bank branches has to happen. I think eventually what happens is that today the transactions which are happening at the branches are the people who do not have the financial literacy, more importantly, digital financial literacy. Because they don't know how to use the digital channels, they are going to the branches. So the first part would be that the way the financial literacy is happening, and more importantly, I keep telling the financial literacy should always focus on the digital financial literacy so that the adoption at the operating level happens. And it is likely to happen. It's only a matter of time. So my worry would be that some of this P2P lending and other things, while they spur this digital literacy, in the absence of digital literacy, you push too much on the P2P, there would be pain. We have seen that digital lending applications cheating the people and people committing suicide. I think we need to tread this path very carefully. That we need to encourage our people. And in fact, today we have hundreds of financial literacy centers across the country under the mandate of RBI, where the banks manage them. We are insisting that these financial literacy centers have to focus on the digital financial literacy, educate the people. What are the threats? What can go wrong when they have download an app? So with that, what happens? The people visiting the branches will come down. But what happens to the branch network? Will the customers completely abandon the branches? I don't think. I think they would eventually make way for these branches becoming the financial advisory centers. Because I think the transactions will effectively move out of the branches, but there could be somebody investing in a house, somebody investing in a some large financial product would still want a face-to-face. That face-to-face also moved to a video channel, but maybe it will take some time. Our thinking is that how do I make my branches to reinvent? One is that they will be a center for digital kiosk, and then you have 3-4 people who are essentially advisors. They will advise on the investment. They will advise on the larger investments like home loans and all. I think this is the reinvention which is likely to happen. Transactions would effectively move out of the branches.
True. No, I think very well put, and I think, and I must, as I said again, commend SBI for really having really walked well on the digitization bandwagon, and generally, and I'll give you honest feedback from the ground. When you speak to actual people who are using SBI, everybody has very good things to say. People are very happy with the SBI platform, the digital platform, the payments, and dealing with everything. So I think it's been an excellent discussion. Thank you so much, Mr. Sethi, for taking the time out. And really, I'm certain that our listeners and our members have really benefited from your wisdom. Thank you so much.
Thank you, Amay. Thank you very much.
Namaste ji. Thank you so much. Thank you. So Ratish, over to you.
Yeah. Okay. So we're just waiting for Dr. Krishnamurthy to join in sometime. He's stuck in another meeting. In the meanwhile, we'll move forward to our next speaker, Mr. Nagaraj Garla, Co-Chairman, ICC Western Region and Executive Director, IDBI Bank. Sir, could you please deliver a small note of yours?
Respected Chairman of ICC Western Council, Amay Prabhu, Mr. Rachalla Srinivasan Shetty, AMD, State Bank of India, and Krishnamurthy Subramaniam, Chief Economic Advisor, Government of India. Good afternoon, ladies and gentlemen. So if you look at globally, actually, there is a perfect correlation between the size of the economy and the banking sector, actually. So to accelerate or to achieve USD 5 trillion economy target set by our Prime Minister, Mr. Narendra Modi, undoubtedly we need to have a higher contribution from the banking sector. Hence, this banking summit at the appropriate time. Broadly, summit is likely to focus on 3 important areas, actually. Digital landscape, I think Amay as well as Mr. Shetty has touched upon what is the importance of digital strategy in the overall organization strategy of all banks, actually. So digital is a very important piece which all banks have to attend on that, and no choice, actually. They are likely to play a very important role to serve the unbanked, as well as to achieve inclusive growth and to reach a last mile connectivity and also timely servicing of the customers. and giving excellent scope for new sectors like telemedicine, telemarketing, entertainment, and e-commerce. Hence, new priority and new digital focus for the bank. And I think today it is a part and parcel of everybody's organization strategy. Without digital, I think there is no organization strategy for any bank as on date. So first panel is going to discuss on this. I think I'm 100% sure all our panelists are well versed with digital journeys. So I think all participants are going to have a benefit out of their experience. Second theme, actually, most of you must be knowing, actually, most of the Nbfcs, they are actually planning to convert themselves into bank, and most of them are working out plans. Board level committees are happening, and they are seeing actually what are the challenges, what are the opportunities. So we have experienced panel who is going to discuss actually, what are the opportunities and challenges for Nbfcs to convert themselves into banks. So that is the second panel which is going to discuss. I think it is a timely session. So we thought actually, all participants will get a rich benefit out of that actually. Third, and which is a very important session according to me, is last 4-5 years, banks have been cleaning up their balance sheets, and actually, idea is actually, view is that they are not focusing on a present and future opportunities, whatever is the economy is throwing, because they are busy with their past legacy systems. So whether creation of bad bank would help them to clean up entire legacy issues, and whether the banks are going to focus on present and future opportunities. So this is the third panel which is going to discuss whether creation of bad bank is going to take away all asset quality challenges for the bank, and whether they will be in a position to focus on a future business opportunities. So this is also very important discussion. We thought it is appropriate for participants to have a we have an excellent panel. I'm sure actually this would enhance the knowledge of most of the participants. During last 3-4 years, friends, actually government has taken various reforms, including creation of IBC legislation piece, amalgamation of public sector banks, redefining MSME enterprises, setting up a bad bank, creation of National Bank for Financing Infrastructure, NIF, Atmanirbhar Bharat, privatization of public sector bank, PLI scheme, emergency credit line guarantee scheme. So all these are actually plenty opportunities the banking sector can have from out of all these reforms. Mr. Shetty has touched upon various things like a COVID impact on asset quality, capital adequacy, thin balance sheet problem, and the stress on a retail banking portfolio, adoption of digital platforms by common customers, business continuity plans, hyper personalization of banking is the key to stay in the business, how corporate banking is shaping up in adoption of supply chain solutions, and redesigning the purpose is the key to stay afloat in the business for the bank. I think he has shared a very, very insightful thought on the future banking landscape. Despite his busy schedule, he could accommodate our request and be part of this summit. Thank you, Mr. Shetty, for being with us at this point of time. I think Mr. Krishnamurthy is likely to join us within a short span of time.
Thank you, sir. Moving over until we wait for Mr. Krishnamurthy to join in, we'll start with our first session on the next generation of banking. The panel chair for this particular session is Mr. Prasanna Lohar, Head of Innovation, DCB Bank. He will be joined by Ms. Shalini Waria, ED of Federal Bank, Ms. Joseph Joshi, CTO, International Financial Services Center Authority, IFSCA, and Mr. Charles Allen, Senior Advisor, Digital Operations, TPG. He'll be joining in sometime. Over to you, Mr. Lohar.
The initial disturbance. Yeah. So thank you, Ratish. Shalini ma'am, am I audible to you?
Prasanna, good afternoon and good to see you.
Yeah, good to see you, ma'am, and good to see you, Joseph. Also, I think we've
Hi,
been talking with Joseph since long time. I think while we are waiting for Charles, let's begin with our panel discussions. I think that the topic for our panel discussion is quite interesting, and it's keeping me, at least for me, it is keeping me awake these days, 24/7, always thinking of how can we bring much more better banking for customers with a better business models, and what is happening all around us. New technologies are coming up, emerging technologies, and there are threats like hackers are out there. So we have to keep an equilibrium of a banking ecosystem within a bank and outside of the bank, provided what we are really providing to the next generation banking, right? So next generation banking could be for new customers or existing customers with out there we have a huge competition or collaboration we will discuss during this session. Competition maybe from fintechs or tech fin companies. There is a quite a lot cultural shift happening within a banks. The day I had joined bank in my bank, like DCB Bank out there in 2014, I thought I think I'll be working from 9:30 to 6 o'clock. That's how my life will be there. And earlier I used to work in a tech company. I thought tech companies are really doing so much of work, and now let me go back and see, enjoy how banks are really leveraging on technologies. But I think it was vice versa. Like the day I joined the bank, I think India has seen massive adoption of NPCI's ecosystem, and out there demonetization, and every bank and these jargons on digital transformation, new technologies like open banking, API banking, new roles brought into the bank. My role was also being created for a certain agenda of the bank. So that has really given a momentum of overall banking in India. I think the way post demonetization UPI has given a quality of collaboration within a bank, right? So we have seen a number of business models, and these days every student which is coming out of the college and talking about fintechs or startups and starting some embedded finance or open banking kind of a business model. And last 12-15 months, because of COVID or that kind of a shift where customer behavior is changing, more and more of the less customers are glued to the digital mediums to adopt services like Netflix or Amazon Prime. Similar experience they want while they want to do some banking with any of the banks in India. Quite a lot of work is happening on a regulator side. RBI, Joseph will talk us about IFCA, how what is the role of IFCA within a Indian banking ecosystem, or new technology like AI or blockchain. A lot of progress has happened in these last 3-4 years. Blockchain, I have seen in 2016 writing a blog, and today I think massive adoption from 3 companies which I had seen in 2015 in India. I think that number has reached to 150 plus companies. So I think quite a lot of things are happening to make current banking to the next gen digital banking. So let me begin with our mentor guide Shalini ma'am, who is really driving a lot of agendas at a federal bank. And we look at how federal is really, I think recently federal was awarded on looking at the digital payments, right? At RBI is #1. That gives a really massive key, a bank like which is not a massive bank like SBI or but create breakthrough with how is experience at a federal. What does that mean by next gen digital banking? You all the time are keeping you awake and keeping you motivated.
Thank you, Prasanna. I think your line is giving some trouble, but I got the gist of the question, so I'm going to go ahead and start answering it if it's all right. So let me go ahead. Thank you very much for inviting me to this panel discussion. Very interesting concept of the next generation of banking. I'm not sure whether any of us can talk competently about it because it changes by the minute, it changes by the hour, but I'll try and see what I can do in terms of to it. So I think when you ask anybody a question as to, what are the emerging trends in banking, what is next generation, the typical answers you would get is there's, a huge amount of attention on artificial intelligence, data analytics, blockchain as an experiment, internally the use of RPA, absolutely, all of these are valid and appropriate. But the way I look at it and the way Federal Bank looks at it, and I'll step back a little bit to say that what essentially is changing at the customer end of it, that's really what's going to drive the next generation of banking. And there are three themes that we in Federal Bank believe are the most important trends that are happening. There could be many, but for us, it's the three of them that we have picked up as trends on the next generation. The first is what you, Prasanna, alluded to, and what I think the whole conference will focus on, which is this whole focus and attention on contactless/digital. The world is moving entirely into that framework. COVID has precipitated it, but even before COVID, India had made huge advances, demonetization, GST, etc., where contactless digital is becoming at the forefront of what customers want. Today, it's reached a stage where customers are keen to not have to walk into a branch for even any transaction, from whether it's even things like gold loans, etc., which traditionally used to be done in a branch, is today being done outside the branch in some form of digital fashion or the other, semi-digital, partially digital, fully digital. So I think contactless digital is definitely one area of focus from a next generation perspective, and I'm sure we'll talk more about it. But there are two other trends that we believe will impact the way we deal with customers, the way we interact with customers. The second trend that we think is important is what is called sachetization. If you go back in time, Prasanna and the team, years back, I think when shampoos were introduced in sachet forms, as you know, it kind of boomed the sales, and people just took off. And then since then, you've had sachets of various kinds. Increasingly, banking is also becoming sachetization. People want the ability to kind of, small deposits of small value, but multiple of them, want to be in a position where they do small value loans, which is why buy now, pay later is becoming so popular, while credit card on EMI is becoming so popular, debit card on EMI is becoming popular. Because I think the mindset in the customer is, that how do you make sure that you're not committing to a very large frame? You're doing small transactions, and therefore this whole sachetization impact is coming. So that's the second trend. The third trend is customers are increasingly convinced that the power of one is important for them. They don't want to be treated as a number on the database. They don't want to be treated as just another account number. They're saying, I am an individual, respect me for what I am, what I bring to the table. I may not have 5 crores with you, but what I have is important to me, and therefore you should be able to deliver to my requirements at a customized level, at a bespoke level for that individual customer. So I think these three trends, contactless digital, sachetization, customization, are like the overarching trends that we think customers are working towards. What are its implications, therefore, for banks like us, or any of whoever's working in this market? One, I think we'll have to leverage technology even more. So I think, Prasanna, I can relate completely to what you said, which is you thought you joined the bank, but it's more a technology company, which is true, because today technology has advanced so much that if you have to cater to contactless, if you have to cater to sachetization and customization or bespoke solutions, it can only be done through technology. Otherwise, the costs would be prohibitive, the timelines would be restrictive. So banks therefore need to get to the culture and mindset of saying technology is not an end in itself, but a means to a better end for the customer, a means to. So that's leveraging technology. The second aspect that banks would need to focus on is empowering people, the employees of the thing, empowering them to know what is out there in the market, to see what tools and techniques they need to develop, etc. So a combination of leveraging technology and empowering people will, I believe, help banks like us and DCB and any others in the franchise to deliver to what I think are the emerging customer needs. So that's really what I'd like to say as customer. Next generation banking is not so much about artificial intelligence, RPA. Yes, those are tools, but the real purpose is customer delight. And I feel customers are moving this way: contactless digital, sachetization, and customization.
Yeah, I think very well narrated and summarized. what's your view, Joseph? What is really happening? You must have seen the whole banking eternity since last 4-5 years, taking different shape altogether. And there is a new set of customers are coming in, like millennial customers, right? How do you see that the banking will change in the next few years? Yeah.
Yeah, thanks, Prasanna. Hope I'm audible.
Yes.
Great. And yeah, good afternoon to the respected panelists, both of you and all the other viewers. Thanks for this opportunity. And before, stating my views, just want to give in the standard disclaimer, right? All of the views are very personal here, and I do not represent the views of the Unified Regulator, IFSCA, which is a statutory authority established by the Government of India. So these are all very personal views, which I'm going to share over here. Yeah, so we were interacting during those days when I was with RBI's IT subsidiary here in Mumbai for the last 4-5 years. And then when this new regulator came up, I shifted base to kind of GIFT City here. So we did see a lot of trends, right, from a regulator's standpoint. Of course, fintechs, the rise has been just phenomenal. Every other day, there is a new deal getting cut. Somebody's getting into a series A, B, C, wherever it ends. Unicorns, decacorns, I do not know where we're going to end. So very exciting times we are in, that's for sure. But then I also see, the way the banks are reinventing themselves, that's also phenomenal. Like we heard the MD of SBI talk about, and I'm sure YONO by itself could be a super digital bank on its own if I have to carve that out from the SBI stable. So overall, it has been a phenomenal journey. However, what I think is the way it's going to go to the next level. So today, there are a lot of key things like climate, ESG, all these are big terms everybody's talking. And I'm sure probably banks like, I do not know if you've heard of it, Meniga, I think there is something like an aspiration, the neobanks like from the US or London. They focus a lot on these climate related things. They kind of say, hey, I'm going to give you a credit card, which is kind of towards the net zero target, the carbon neutrality, and I will plant a tree for you. Or they kind of bring in all those carbon insight services based on your spend. How long are you going to, kind of crash the ecosystem over here? Like, what is your spending habits and what is the impact of it? So it gives a very different perspective. And I think those are some of the areas where I think we'll have to kind of do some work within the Indian ecosystem. So overall, fintech versus techfin, that's an interesting combination. I know your Googles and Amazons of the world are coming in, so that's going to be an interesting play. I think RBI under the new umbrella entity, they're trying to play it well. But overall, I think it's a brave new world out there, and I think the fittest is going to survive. Those will be my 2 cents.
Yeah, I think it was not really 2 cents, I must say, Joseph, the way you narrated. Like your journey was being fabulous from Revit, right? Revit these days are coming up with a massive ecosystem, right? Account aggregator. The way we have seen UPI has made some magic around payments in India. I am really looking around account aggregator, how they will take care of many other instruments, not only payment, but savings account or current account, or helping those SMEs, or bringing the standardization of APIs, which is a really requirement for those fintechs who want to get integrated with the banks, or banks want to get integrated with the fintech. So we'll be able to save a lot of cost, and moreover, we'll have a better security architecture and data architecture at a country like India. And I must say, if we really execute account aggregator governance and operations, other countries will look at as a massive ecosystem the way we have built account aggregator. And if you adopt a new technology like AI and blockchain within account aggregator, I really can't say what all magics we can really bring. So I think, thank you so much, Joseph. Moving on to Charles. Welcome, Charles. So we were discussing about what are the different trends in banking ecosystem, right, which we have seen. I think I have visited bank branches way back in 2000 or 2003 for opening bank account. It took around 30-35 days, and I was so happy, right, with my own bank account in 35 days. I must have done a lot of promotion for that bank. You should go to this bank branch and they open your bank account in 35 days. I have seen those days with my father standing in a queue with a brass token, right, for taking out the cash. So Charles, how do you see last 20 years and maybe recently last 5 years? What are the different trends? Banking is really shifting to the next wave, right? I'm not sure, maybe today we might be doing the transactions, maybe tomorrow, I'm not sure who will be that entity who doing the transactions, maybe machines or cars. So over to you, Charles, if you can really highlight your experience around the next gen banking. Yeah.
Thank you, Prasanna. And you're right. It's been a remarkable change, really, over the last few years. And I think if I was going to summarize it into a single soundbite, I say we finally asked customers what they expect to happen in terms of how quickly they expect their experiences to occur in banking. And of course, it turns out that what our customers expect in banking is very similar to what they're getting from the rest of their life. And that's increasingly in the last, well, really 10 years, that's inspired by mobile and by all of the other apps that they have on mobile. And of course, it can be any time as long as it's right now. So increasingly, it's not about 35 days or even 24 hours. If I can do it in the next 5 minutes, then you have my attention. And if it's longer than 5 minutes, then I'm getting bored. There was something that we were talking about, customer expectations at the company I used to work at HSBC recently. And how long should we let people expect customers to wait? And we came up with a very simple rule. If it's less than 0.1 of a second for an interaction to happen, it's effectively instantaneous for customers. If it takes 1 second, then they notice it, but they're prepared to stay with it. And if the interaction takes 10 seconds, then they think it's broken and start disengaging from the journey that you're presenting them with. And these sorts of rules that we need to be responding in that kind of time frame, I think is how we all increasingly expect our digital banking experiences to respond. And so back to your point around account opening, yes, the days of it taking days and months and probably involving physical documentation in the branch or calling into a contact center or maybe mailing in documents seem like they're long over. And really, as we know, the answer is to bring the customers into the process, listen to what they're saying to us, and iterate fast, and ultimately make it a much easier experience. Every single time we make it a little bit harder with one more question or one more field for them to fill in, we see the dropout in the number of customers happy to go through that step. So reducing the complexity, reducing the number of fields is the name of the game.
Yeah, Charles, very well said. I think the banking has changed. We keep adding new channels, right? Say example, mobile banking was not at all there 10, 15 years before. Now we have mobile banking, or internet banking was added before mobile banking. We were always relying on those bank branch infrastructure, and I'm not sure how bank branch infrastructure has been utilized in last 15 months when COVID was there, right? And all of a sudden there is a human behavior change or customer behavior change. They would may not like to really go to those bank branches. I'm not talking about the villages where completely reliability on a bank branch structure, but typically the customers who are glued to those next gen OTT platforms or media platforms, they would like to see similar behavior in a banking ecosystem also. So-called cross-industry innovation, they are really looking at it. So banks are always looking at how they can bring much more needed services on the front office to the customers, as well as what they can bring in the back end, improvising the architecture or improvising the skill sets. And there are many things to do. It's like re-architecting your complete bank while you are driving your day-to-day banking operations. Why? Because there is another wave of fintechs which is coming, right? Earlier those days we used to talk about fintechs are like competition to us, but recent trends which you have seen, right? Like Google Pay, Phone Pays in India, or maybe outside of India, like Uber and many other companies are collaborating with banks, right? Or challenger banks. You talk about neo banks. They're collaborating within that country banking license and providing needed services. So, so Shalini ma'am, what's your view on this fintech adoption? Do you really see maybe by 2030 banks will remain as a government bodies or trusted bodies, and they will provide, maybe Yono is one of those great examples, right, to build a super apps, right? How do you see this whole equation between banks and fintechs? And yeah.
Thanks. At the outset, fintechs are for Federal Bank very, very clear. They're collaborators, not competitors. That's our strategic intent. That's how we've participated in relationships with them, etc. So we clearly believe there is a role for a bank and there is a role for a fintech. The best for the customer is when these two to come together and deliver the best experience. So I'll start off with what I think Charles alluded to, which is to say that customers today have reached the stage where they're expecting, their banking experience to be as seamless and as convenient, like buying food on Swiggy or buying something on Amazon. While at the same time, don't forget, customers want the trust of a bank, the brand of a bank, the trust that I'm giving you my money, and therefore you're going to keep it safe, is clearly something in the minds of the customer. So the confluence or the congruence of coming together of these two, which is somebody that gives you the convenience of a Swiggy or an Uber or a Zomato, but the trust of a bank, is, I think, the best combination for the customer. And that's how we've approached our relationship with fintechs. We started this journey in Federal Bank about 3 years back. We initially identified this to be a target segment for us from a standpoint that it will improve our distribution. So we have 1,200 branches, but through fintechs, we believe that we will not have to invest in extensive amount of branches, but these fintechs will give us the reach that we need. And it will kind of literally give a triple X effect, so if it's X branches, we can be 3 times that through fintech. So we started with lending. We started doing our personal loan product on the Google Pay platform, on the Paisa Bazaar platform, etc. We tied up with Fine Labs for debit card on EMI, with BillDesk, various things. So, we started with lending. We then moved to payments. We are one of the biggest processors for Bharat Pay, which is the personal merchant category, making inroads into the merchant landscape using UPI. And earlier this year, as you know, Prasanna, we are the bankers too, and we've launched with both Epify, which is the Fi app, and with Jupiter, which is the neo banking proposition. We're the only bank that provides the capabilities at the back end. So this is all part of a strategic intent to make sure that the customer gets the best of all the worlds. And distribution is doesn't necessarily have to be owned by Federal Bank. Distribution can be owned by any of them, but we provide the banking services. We provide the platform through API banking, to open banking, etc. So clearly, fintechs are a big ingredient to our strategic intent. We're very, very careful. We're very, very close at working with partnerships with them. We do believe they bring huge value from a customer standpoint. We do believe they don't compete with us on that, because there are some things which only a bank can do, and that's the landscape we see. I mean, I don't know if it's 2030 or 2035, but clearly the landscape we see in the foreseeable 4 to 5 years time frame is banks will have a role to play. Banks will give confidence to customers. Banks will give security to customers, but fintechs will have a role to play in making it easier for customers to access. So that's broadly where I think the fintech revolution is going, and we're very happy to be a part of that journey to grow. Clearly, things like UPI have helped immensely. The account aggregation, which as we speak is going to get formally launched in less than an hour from now, as at an event. I think those will be game changers for this economy.
Absolutely. I think the way you narrated the fabulous journey at a federal, it's fascinating to see, right? For a tech company to an aspiration to create an infrastructure and provide those services to the banks, it's a bread and butter for them. But the way you have done at a federal, right? So while running from a traditional bank years back or so years back, getting into those architecture building exercises or those building blocks to make to welcome those fintechs, let's collaborate together. It's not a 1 day, 2 day journey. It requires a lot of contribution from people internally, a lot of role changes, skill set alignments, And moreover, the way regulator is also supporting, right, on the security guidelines, how we should really collaborate with the fintechs, how we should have all, and those ecosystems are also now ready in front of us, right? So Joseph, you have seen Revit formation, right, and getting into those account aggregator, and you have seen the role of regulator is becoming more and more important. Rather, we are blessed with such a nice regulators like RBI, at least in banking ecosystems, with the adoption of those OTPs, right, way back in 2013-14. And since then, lot many changes or guidelines are coming, and those are always giving us a kind of a comfort. Yeah, we are, as a country, we are moving ahead with the right direction. UPI or any of those innovations which were part of RBI's vision statement, right? And maybe tomorrow we will see the CBDC, central bank digital currency, or which are again part of those vision statements. So how do you see the fintech alignment is really helping banks or whole banking ecosystem? And there is a lot of efforts does goes by fintechs to really work around, test around, right? Unavailability of those sandboxes or availability of those sandboxes, which you see in countries like Singapore and all. So what is your personal opinion around it, so that this journey for fintechs becomes smoother? Yeah,
Absolutely. So, see, fintechs are a very important and an integral part of this ecosystem if we have to survive the storm, that's for sure. And the way we have seen, as you rightly said, account aggregator, I mean, some of my team members were part of those APIs which we built. So we're really proud that we got it out. And Oken is coming. And the way it's all setting up, like, you start with your open banking, as you said. Tomorrow, probably, I would see it as an open finance than just an open banking, because it's going to spill over to the other sectors as well. And us being a unified regulator, I mean, for those of the audience who do not know, International Financial Services Centers is a unified regulator with the powers of RBI, SEBI, IRDA, and PFRDA within the IFSC zone in GIFT City. So we are seeing spillover efforts into insurance, open insurance probably, or open kind of pension funds, open mortgages. So I see a big open finance ecosystem coming up thanks to what's happening within the open banking or the banking ecosystem. And later I see this moving into an entire open data kind of an ecosystem, and hopefully the bill will come in data protection and related stuff, so that India as a country can leverage the data. Coming back to the fintechs part, I mean, I was lucky to be associated, in some manner with the RBI sandbox. And over here at IFSC as well, we have set up sandboxes for fintechs, like both the regulatory and innovation sandbox. And in addition to that,
awesome.
What we are doing is, we felt that each regulator has their own sandbox and they're operating it in silos. So we need a interoperable, regulatory sandbox. So we have a kind of a working group under the FSDC umbrella, where we are trying to put in some standard operating procedure as to how can all these 5 financial sector regulators, basically the RBI, SEBI, IRDA, PFRDA, and IFSCA, can come together and have a framework around this interoperable regulatory sandbox. So that's also work in progress, which will soon see the light of the day. But overall, there is a lot of thrust on fintechs. There is no doubt about it. The kind of relaxation we are giving within IFSCA, it's kind of something we can do because the jurisdiction is only the IFSC, and we can kind of take it in a more kind of progressive manner, because when you take RBI and the domestic economy, probably you need to balance out 2 extreme things. Like you might have the foreign private banks at one end and the cooperatives at the other end, and you might have to take a middle path. Whereas within the IFSC, we have the opportunity. So that's where in our regulatory sandbox, you would see, tokenization related applicants coming in, where we could kind of see how things are happening there, so that, we can come up with, say, a fintech entity related framework or regulations around it. So we are trying to do as much as possible to enable the ecosystem, and we are all for the innovation ecosystem over here, because we think that is what is going to win the game.
Yeah, I think awesome, Joseph. I think we were talking about what's really. Yeah, I think we were talking about what's really happening around the banking. I think Shalini Madam spoke about what is happening within the bank, and you are talking about what is happening outside of the bank, right? So Charles, over to you. I think you had a massive experience at HSBC now at TH. So I think important aspects, right? The cultural change, digital transformation, or taking your bank to the next level, right? I think in India we have different set of banks, cooperative banks or a small finance bank, or you have like large sector bank, or we have a challenger banks coming like open banks, and every bank is now looking at how they can really go to the next level, right? So what is your view, Charles? I think you are on mute. Maybe you can unmute and say, if a bank wants to go to the next level, what are the different driving factors like culture change? What is that really? Those things we need to take care apart from right technology, because technology will keep on changing, right? But the people will remain together forever, right? As long as they are within a bank or within a banking ecosystem. Yeah.
Yeah, it's a really great question, and let me go at the cultural part from two areas that I've seen and experienced that I think in banking we find difficult. The first area is the relationship between the business side and the technology side, and then the second area is the relationship between, I guess, the business side and the control functions, and maybe just going at those two areas. The first one on the business and technology, and a lot of people have commented on this. It's we've had a model for years and years where business write requirements, they throw them over the fence to technology build it, business get crossed with technology when it doesn't come in on time and on budget, and technology get crossed with business when the requirements change, and ultimately that whole model has to change. And I think most companies that are really competing well now in banking have changed that relationship. And so it is not a participate and meet with your technology colleagues once a week or once a month or once a quarter. It's work with them absolutely day in, day out. And in the world of COVID, that doesn't mean necessarily sitting in the same room, of course, but it does mean the business and technology being part of the same team and working day by day. And I think that's the first really important change. And then you get into being able to respond faster and being able to make decisions that are easy for the technology team to build, and all of those good behaviors. So that's one critical area. And I think everyone's quite familiar with that change, although I think it's still quite a way to go for many financial service companies. The second area that I've experienced is just on the control space. So the compliance functions, the regulatory functions in the bank, the legal functions. This piece around fast iteration. My experience there was that terrifies many control functions, because that sounds like we're going to be releasing all the time, and how are we going to make sure we do that in a way where we have robust control around it. And that piece of cultural change I've experienced is quite difficult for people to get comfortable with until they've gone through it a few times. And by that I mean the initial release of a new product or platform that is going to be re-released again in 2 weeks' time or in 1 month's time. That can be quite difficult, because everyone gets nervous about control functions. But that when we get used to that, and then actually we're going to do a very small change, but we're going to release it in 2 weeks' time, and then we're going to do another very small change and release that 2 weeks later, we realize that actually we have more control, because it's smaller changes and we can roll them back if things go wrong, than in the world where we did 2 releases a year. So I think those two areas have been on the relationship with technology and the role of the control functions in the bank to make sure that we are doing things the right way for the customers and for our regulators. Those have been some very big cultural changes, and I definitely see examples of those working really well, and examples where we haven't quite got it right, and people are in conflict with each other as they try and go through this change process.
Yeah, I think thank you very much, Charles. Shalini ma'am, I think you must have also seen.
Yes. Can I add to that, Prasanna, as an extension of that?
Yeah. Yes, absolutely. This is what I was about to ask you.
Okay. Thanks very much for that, because I think Charles has set the background very clearly. So I think this is more reached a stage where it is all in the mind now. It's no longer about, I think technology, all of us have become quite adept at understanding what the technology is. I don't think anybody any longer blames so-called legacy technology for not being agile, with middleware, etc., being so rampantly used with APIs, open banking. That's a level playing field. Where I think the big difference is in the mind, as I said, and the whole effort around what Charles was saying, which is how do you get to be more collaborative within the organization and across the across organizations, both internally and externally. The whole theme and philosophy is around collaboration and leveraging that collaboration to deliver for the customer. So internally within the organization, I must admit it is a challenge at times because people have different roles. Business has a certain role, technology has a certain role, the risk management colleagues have a role to protect risk and make sure nothing goes wrong. Compliance obviously has a role to ensure compliance, legal has a role to protect. So how do you get all of them to come together in a frame of mind which is they understand they have their independent roles, they understand they've got to bring the independent perspective, but they've got to come together to deliver for the customer. And what we have done to kind of make that better, and we're still learning, there's still a long way to go, is to a very large extent, we've driven a culture which says, we will create small working groups that are functional, cross-functional in nature, and do a lot of thing in empowerment. And when I say empowerment, it's very difficult, Prasanna, to kind of document this empowerment in a note. It's not that, I'm giving you $1 million, go ahead and do it. It's about challenging mindsets. It's about challenging thoughts. It's about balancing risk and reward. Yes, there is a risk, but is the reward worth it? And are you taking that? There are some non-negotiables. Regulatory risk is non-negotiable. Operational risk is something is within your risk appetite. So, the whole mindset is, okay, get this small group of people together, empower them, control it in the sense of making sure that you verify what they're writing, be available for them to come back and talk to you about issues that are there. So we've encouraged that internally. And we also, as extension of that with our fintech partners, we now have a fairly rigorous discipline which says that we will Prasanna, we're at any point in time dealing with 30, 40 fintechs, in various categories, some in ideation stage, some in production stage. So we have a governance process by which we do a joint review with them every month to make sure that. So this collaboration internal and collaboration external is one philosophy and mindset that we're doing. The other is about, and tech companies do it better, I'm sure, than banks, which is fail, but fail fast. If you have to make a mistake, yes, we appreciate, I think there are mistakes I can document that we've done even in our fintech journey, but do it and, move on. I mean, there's no point repenting about it. Make sure you learn from it so that we don't have to do it. So failing and failing fast is another kind of philosophy. These are all new to banks. Banks have not been used to these kind of things, so we've got to build that culture and the people build it and, keep continually working with people to say, this is a very, very different mindset.
Yeah, I think fairly great views. It's not really a technology adoption or building a mobile app or very great experience. I think we need to take care of our people. If we take care of our people, reskill them, or create those right governance structure, right processes, and keep we can innovate outside of the bank also fairly well. I think any views, Joseph, from your side on this aspect?
See, as somebody who's been in the Bay Area, hearing fail fast is like music to my ears, to be honest. Yeah. And I'm so glad our banks are taking the Silicon Valley way, and that's the way to go forward as well. So in addition to what was said, I just want to also touch upon another area. Like, I know our fintechs are powering a lot of our banks here, and our vision, like the Honorable Prime Minister's vision, is also for our fintechs to take on, on globally the other aspects too. So what we are trying to do is we are trying to also give them opportunities to list. So for example, in the IFSC, the international exchanges are there. So today the fintechs need not go all the way to a NASDAQ or Singapore to get listed. They just need to come over here to GIFT City and get listed, right? And the regulations which have been coming out, the prudential norms have been diluted. So what we're trying to do is encourage that entire ecosystem, create that enabling ecosystem so that our fintechs can really take not only just the country's banking sector, but also the other sectors, and globally they can really, steal a march. So overall, we are looking at the point that where our fintechs are really going to take over and make an impact globally.
Yeah, I think one theme, while we talk about internal people or we talk about happening externally, so everything is driven by technology, right? So earlier, it's like a telecom companies has really helped banks, right? Providing those bandwidths or internet, mobility or so-called social media banking. Adoption of cloud is now almost there. Like fintechs are always on cloud first journey. So inherently, banks has their business model on the cloud. While we are now these days, I think big data and AI are becoming normal technologies. If you are not really adopting, I think you will miss out the wave of understanding your customers for sure. RPAs and quite a lot of technology are coming, blockchain or crypto. There is a lot of buzz around technology always, right? So Charles, what are your views, right? How organizations should really adopt technology? Say example, crypto, right? There is lot much of buzz around crypto across the world, and in India, I think we don't have that much supporting in regulation as of now. Okay, say but if you talk about blockchain, there are a lot of use cases being piloted at banks level. We have a new huge infrastructure company coming in, which will work around trade finance and so on the blockchain, right? At a country level, we have blockchain strategy papers or AI strategy papers, cloud. There are guidelines from RBI. How do we really adopt various technologies? Okay, so what's your view on how it is very important for an organization to keep an eye on emerging technologies so that we make them normal technologies within 2-3 years, right?
Yeah.
And how do you collaborate with your partners while doing this? Yeah.
It's a really good question, and maybe just to the area from my perspective, there are also lots of technologies that sound great, but we haven't managed to find a good use case for it in banking. And so you have to be very careful that you don't get very excited by something, invest time and money in it, and actually there's just nothing there for our customers and for the business. So I think if I just take a few examples of ones which have gone from being interesting ideas to being mainstream ideas and where we are on that. I mean, you mentioned cloud, and I think that one's very obvious. We all now understand the benefits of cloud infrastructure and thinking about how it gives us stability, and databases are increasingly comfortable with that. And so I think that's a good example. I would say something like some aspects of AI, I'm going to call it machine learning rather than AI, is now getting to the point where it's really ready for prime time use. And I think there's a whole wave of benefit that banking can get from using machine learning techniques. I'll give you just two examples that I've recently been close to. One was, and they're both very simple. One was around loading cash. Bank customers still do use cash and ATM machines, but loading ATM machines with cash and forecasting how much money you need to have in an ATM when the van turns up to fill it up this week, and ATMs all around the country. And we used a machine learning model, trained it on 2 years of data, and through that we realized that we could optimize the cash loads so that you reduce the number of trips to the ATM by the cash company by 1 trip a month, and you add that up across many thousands of ATMs and obviously the whole year, and you save millions of dollars. So a very simple operational application of machine learning. Another one from the call center world. We all do call listening of various types to make sure we are not we're handling customer interactions well, and often linked to mis-selling, making sure that there's no mis-selling going on of products on a telephone call. And often that's sample based. So we would sample that and we'd say, hey, we're going to listen to these calls and then go back and identify problems, remediate. And again, with machine learning tools, you can now automate all of that so that you can have 100% of your calls listened to. You can do text to speech, speech to text. You can analyze that and then do 100% remediation in the event of mis-selling. And you can actually improve the sales quality and reduce your operational costs using machine learning. So I think machine learning is a technology that is absolutely ready for the prime time, and I would encouraging everyone to be looking at opportunities for applying ML. And then you mentioned, crypto and CBDCs, and for me, there's a whole set of technologies there that we're still trying to figure out exactly what the play is. Would be my overall comment. We've got sort of smart contracts, which are interesting. We've obviously got the currency aspects to it. There's a whole lots of pieces there that in my view, we're starting to get some very interesting plays on, and I think CBDC is probably one of the most interesting in terms of provided by governments, by regulators, by central banks. But for me, there's quite a lot of pieces there that we haven't really figured the broader application of, and I think the next 5 years we will discover ways that can be really powerful and really value adding to banks. And then I think to your overall question around how we should deal with these, Prasanna, for me, there's it's everyone's job in the bank to stay across what these developments are and to be thinking about how they could be applied, and then promoting those and running little tests around it. So it's a complicated space. No one wants to waste any money on technology that doesn't work. Some is very, very much for the prime time. Obviously, cloud. I'd certainly say ML. And I think the crypto space for me is still a little bit unsure exactly where the crown jewels are, the real value in that one. But I'm sure my co-panelists would have a view as well.
Yeah, I think great. I think Charles. Yeah, Salima.
I think, I agree with Charles completely in what he said. I still think the jury is out on blockchain. It's not yet done and dusted. We don't know. We're all experimenting with it, which is great because otherwise you really wouldn't know the value of it. But, crypto, I think, given the regulatory landscape, I tend to be a little more personally quite more apprehensive about where crypto is going. But there are a couple of other things that I think can become center stage and have become center stage. Maybe one of them is like a variant of machine learning, which is RPA and robotics process automation. We've personally seen huge benefit of this in our operational areas, not so much the customer-facing areas. We've got close to about 220 processes that we moved on to the use of RPA, and I think it's saved us time, reduced error rates, obviously reduced cost because we don't have to deploy people. And one of the great things we learned to our benefit during the start of the pandemic was, they could work on their own without having to be worried about work from home, work from office kind of stuff. So RPA is definitely one. And I think the broad one, I don't know whether this goes in this realm of new technology. Clearly, the whole fintech journey we've undertaken is on the back of open banking or APIs. I don't think it would have been conceivable if we had not embarked on that journey 3-4 years back, if we had not invested in the middleware, if we had not invested in an API banking gateway from IBM and built on it. So these two for me, RPA more internally and open banking as a concept, open banking APIs as a thing, I think are definitely high on the list of my personal priorities for the bank as a whole.
Yeah, I think great views, like looking at, I think Joseph, you want to add something? I'm looking at your expressions. Yeah,
absolutely. It's a very interesting topic. You cannot just not be there without adding any stuff. So, see, when we talk about blockchain, DLT, as Shalini said, jury is still out there. So we are also exploring things. We are seeing, what could be the various regulatory approaches towards some of these things. Because at the end of the day, the technology under it, we need to take a calibrated approach. You cannot just say all of those are cryptocurrency or things like that and keep it aside. But then we need to understand, transparency, trust, all those immutability, all those things are common things which we go with blockchain. But then under the governance part of it, right? How the legal, something goes wrong with a smart contract, how strong is the legal system or recourse within India? Probably US, EU are a little further ahead. So what do we need to do there, right? And then, of course, today NFTs are the flavors of the season. I mean, probably would have heard Amitabh Bachchan going to launch something very soon. But then, if there is a digital, kind of an art, at the end of the day, it's going to be stored in one of the nodes over there. So how are the nodes incentivized? What are the rights management you're going to put so that that for which you're paying, it's only yours and not somebody else. So there's a lot of unanswered questions. So as a regulator, we would want to have our arms around it, that boundary, all those dispute and stuff before you actually kind of bring in. And then comes the question of your security, right? Cyber security. Today, statistics says that it takes about 9 months or so before your entire cycle, the data breach cycle, gets over. That means about 7 months, the breach has started and you don't know, and you take the next 2.5 months to solve it, which means the new year, if you had a data breach, we are still solving it. We are not done. We are in September. So it's going to take till October mid before you're out of it. Now just put quantum on top of this. You said machine learning, very nice thing. Quantum neural networks are coming in, and all your RSAs and SHAs and all those algorithms are at stake. So what happens to your blockchain security when you say everything is so trust-based and immutable? So that is another aspect we need to be aware of. So definitely we are looking at DLT, DAO as an ecosystem, what kind of approaches we should do. And we completely believe instead of being the consumers, we have to be the creators of this ecosystem, because that's where the future is. So completely on board of that, but there are a lot of I's which need to be dotted and T's which need to be crossed before we could finally sign off. That's my 2 cents on that.
Yeah, I think it's very well said, Joseph. I think experimentation research has to be and other thing which you said, that we should be creator, not to have our own AI stack or AI platforms or our own Ethereum kind of a ledger system, right? So I think that's how we should build in our favor, in our regulations. So we'll have, and ultimately what Charles talk about, right? Use cases. Unless we have a use cases, technologies will be many more, right? You can really build a bank in the air with augmented future. But does that really somebody's going to access the services on the right? Or maybe 5G will become reality in next 2-3 years in India. You will have a banking on IoTs, wearables, right? So how do we really bring on those security aspects? Do we say, I'll take care of IoTs as an layer within that? So I think there are you spoke like IDRBT is experimenting around video KYC is bringing on blockchain. They're talking with METI. I think these experiments will take us to the next level. Why? Because there are other industries, manufacturing, so-called gaming. They are already adopting this technology. Cross industry slowly comes to retail, followed by banking or telecoms and so on. But coming back, we will always deliver what is really important for a customer, better customer experience. What are those 2-3 pointers, Shalini ma'am, you can really talk upon, or your thoughts to CXOs? There are a lot of CXOs in India looking at you like as a role model, right? So what is the 2-3 things you should, if you can really help us with your suggestions? Yeah.
So I think one of the things I would encourage everybody to do, and I try and do that myself and tell my team, is keep learning. I think you'd get extremely bogged down in day-to-day stuff. Every day there is something or the other happening, some crisis somewhere, some customer needs something, etc. Absolutely, these things will happen. But if you don't set aside some time to keep learning as a CXO, I don't think you'll be able to add value to the organization or get the right value from the team. So first thing I try and do and I try and encourage is keep learning. So and today, the access to tools for learning are rampant. They're so easy to think. We're gone are the days when one had to go to a library, look for a book, etc. Those days are gone. I don't think any of us will remember those. So I think learning is one thing that I would encourage and do it. The second is what I alluded to when I spoke earlier, which is the mindset of collaboration. I don't think we should treat things as competition. We should treat things as collaboration. And both internally and externally do the collaboration. The third is what I again mentioned, which is fail, but fail fast, learn from it, and move ahead. And I think that's really what I would encourage. These are easier said than done, Prasanna. I can kind of relate to that, particularly if you've been in the organization, have been there for some time, etc. Easier said, and that's where I feel something that adds great value to me personally is what I call reverse mentoring, which is have a mentor who's half your age maybe, who's out there understanding the new technologies, is willing to challenge you and make you think differently. So I think reverse mentoring is a very good way to encourage that.
I think that's really fascinating, right? So at times I feel like the new generation who is coming out of the colleges with a massive knowledge and different thought process, they have different outlook to really solve those great views. Charles, you have any thoughts how a CXO should look at new next generation banking? Yeah.
Yeah, actually, I want to start with just building on Srini's comments about the collaboration, and particularly external collaboration you covered very well in terms of working with fintechs. I think the internal collaboration, I still see lots of turf wars and fights going on inside of retail banks, and it's the opposite of collaboration. It's people trying to grab hold of their area and keep it for themselves. And so I think that collaboration internally is critical. I absolutely support that. Two other areas that I would highlight. I think one is just being an enabler of the technology conversation. So obviously many CXOs are not the CTO or the CIO, but being comfortable with the technology conversation, encouraging it at board level is really important, and definitely not being a blocker for the technology conversation. The technology strategy is not owned by the CTO and the CIO. It's owned by everyone in the leadership team, and I still see people acting as blockers of that conversation rather than enabling it and actually leading it, even for people outside of the formal title of CTO and CIO. And then the final one I'd highlight, and it is really, and it's a version of the reverse mentoring that Srini mentioned, is I just think spending time with a team on the ground that are actually building this stuff. Most teams now will have a regular, probably daily or every couple of weeks, they'll get together, they'll show what they're doing. And I think just turning up and seeing what the team is building every day, every week, every few weeks is so powerful, just to sort of reinforce that this is important to the top team. And so in show and tells, for a senior leaders to be present, ideally present every single time these happen. So on a 2-weekly cycle, being there, asking questions and commenting is just such a powerful reinforcement of the kind of culture that we all want to get to.
Great. I think we had Joseph. You want to add 2 lines in the next 10 seconds? So yeah.
So I completely concur with what my co-panelists just said. Cannot disagree. All valid points. Only limited point, or one last point I want to say is I think probably the world just went through its largest ever digital literacy program thanks to COVID. So people who never used kind of a digital medium to do a transaction payment, they're all on it. So I think we should use this momentum, to amplify, be it customer experience, top line, bottom line, whatever it is, from the CXO suite. So I think we are at that sweet spot to leverage technology to amplify. And I think that's would be the last 2 words I would say on that. Use the technology to the hilt.
I think such a nice discussion we had with the banking mentor, right? Shalini ma'am, the upcoming leader Joseph, and the global expert Charles, right? I think if anybody would have listened this, like they would have really got a gist or idea. How do you really transform bank while looking at within a bank, outside of the bank, with the new technologies, culture changes, and what role of regulator, role of security around within India, like UPIs and account aggregator. Quite a lot of massive momentum is happening. So thank you so much, Shalini ma'am, Joseph, and Charles, for bringing such a nice insights at ICC. We look forward. I think our audiences will always look forward to carry these thoughts and learnings from today's sessions. Thank you so much.
Thank you. Thank you, Prasanna, Charles.
Thank you, everybody.
Thank you, everybody. Bye-bye. Stay safe, everybody. Thank you.
Thank you, Mr. Charles, for joining us. Ms. Shalini, thanks a lot for those views. And Mr. Joseph Joshi, thanks a lot for sparing time and spending time with us. Thank you, Mr. Prasanna, for that wonderful session. We'll move forward. So we'll take a quick 2-minute break before the next panel starts. Let them
अब मैं देखूं साफ बारिश के बाद हट गई रुकावटें राहों से आज ओ अंधेरा दूर हुआ हुई नजरें साफ जीत का विश्वास हर दिन साफ जीत का विश्वास हर दिन साफ
श्री राम ट्रांसपोर्ट फाइनेंस, जैसी आपकी जरूरतें वैसी हमारी फाइनेंस सेवाएं।
मंजिल मिली है जिसकी थी तलाश जीत का विश्वास हर दिन साफ
श्री राम ट्रांसपोर्ट फाइनेंस, विश्वास जीत का।
Welcome back. We move on to our next session, emerging landscapes of financial services to serve the new India. Joined us over here with us will be Mr. Abhishek Fogla, the panel chair. He's the founder and CEO of Axela Fiduciary. He'll be joined by Mr. R. Bhaskar Babu, MD and CEO, Suryoday Small Finance Bank, and Mr. Umesh Revankar, Vice Chairman and Managing Director, Shriram Transport Finance. Over to you, Mr. Fogla.
Thank you very much, Satish. Welcome, Mr. Bhaskar Babu. Welcome, Mr. Umesh. Mr. Umesh, if I could request you to please turn on your video, it'll be nice.
Yeah. Is it okay? No.
Still not coming, I think.
It is on at my end, but there's something wrong.
No worries. Let us continue, I guess.
Yeah.
Welcome, Mr. Bhaskar Babu. Welcome, Mr. Umesh. Nice to have you on our panel. Today, the panel, thank you to ICC for arranging this event, and good afternoon to all our participants. As you know, this panel is about the emerging financial services landscape, especially for the new India, Bharat story. And it's a very, very exciting time to be here in this segment. A lot of action happening with both NBFCs as well as banks, small finance banks. This is the next wave of growth. So as we all know, NBFCs is a big, big sector in India which has contributed to financial inclusion, which perhaps where the banks have not been able to make that much of foray, the NBFCs have stepped up historically over the past few decades and done that. And we know that NBFCs typically are asset-led. There are very few deposit-taking NBFCs, about 60 odd, on last count, 64, I think. So mostly it's asset-led, as we all know. And whether it's affordable housing finance, infrastructure finance, vehicle finance, microfinance, consumer durables, personal loans, gold loans, CVC, so construction equipment, commercial vehicle, education finance, gold, wholesale banking. So there you have a plethora of segments across which NBFCs operate. So coming to the big picture, I think the big thing is that India today has a population of, 140 odd crores or 135 crores. And, all of us on this call, most of us, I guess, are part of the India A segment, which is already very, very tapped into, very penetrated in every way. We are bombarded with brands day in and day out. Yes, Mr. Umesh, lovely. We can see you now. So we are bombarded with banks with brands day in and day out, and all of us are basically tapped out. Everyone's fighting over us. Now, the next wave of funding the next wave of investment, the next wave of growth across all sectors is going to come from the Bharat or the India B, which is there, and which is the emerging 40 to 45 crore consumers spread across both urban cities as well as in small town India. So I'm very excited that Bhaskar ji and Umesh ji have joined us to share their views. Without further ado, let's okay. So I think the first sub-segment of our conversation was, do NBFCs want to become banks? And I think we have Mr. Bhaskar Babu over here, who started off as an NBFC with Suryodaya Microfinance, and is now a large, thriving small finance bank. So we have a lot of experience, and we would love to hear from him. Just to give you a background, India had declared the small finance bank, licenses in 2015 October, if I'm not wrong, and September or October, and it was 10 licenses which were given, out of which most of them went to the existing microfinance institutions. Capital Small Finance Bank was a local area bank, and AU Bank was obviously an NBFC right then. So, these were the 10, and then the RBI has further given licenses to Shivalik, which is the first cooperative bank to convert into a small finance bank, and now it has given the license to Centrum and BharatPay, which is a very unique combination of a very interesting marriage of sorts between a fintech and a large thriving financial services conglomerate. I believe their small finance bank will now be called Unity Small Finance Bank. So there's been a host, and of course, we also had people like Bandhan, for example, converting from a microfinance institution, into a universal bank. People like IDFC, converting from a project finance NBFC to again a universal bank. So we've had several such examples in the past which have happened, and I would invite Mr. Bhaskar Babu to share his views about the journey of converting from an NBFC to a bank, and what excited him to do so, and how is his journey?
Mr. Bhaskar, you're on mute.
I think you're on mute, Bhaskar ji.
Can you hear me?
Yeah.
Thanks. Thanks to ICC. So when you just taking down the memory lane in terms of how a couple of us as first generation entrepreneurs came to start an NBFC, which itself required funding of around crores. It was way back in 2009. We started an NBFC with a focus in terms of microfinancing lending at that point of time. When we kind of started, one of the key things we realized is that inclusion in terms of inclusion, generally perceived as inclusion on the credit side, to kind of bring. Equally important is on the other side, which is the savings, opening an account, operating. When we wanted to open accounts for our customers, where we are giving credit and it was all cash at that point of time, many of them did not have an operative savings account. They had an account which they probably forgot what the number was, which kind of they didn't have a passbook and so on. The disbursement itself was happening by cash, so which led to multiple things. One of the simplest things is that when you have the entire cash on hand, it finds its way in terms of getting spent. But if it is a bank, you draw out to the extent that you require at the point of time, and more easier the convenient it is to withdraw money, which is very it would have been a lot more easier. So we went and approached quite a few public banks to enable our customers to open an account, and the banks were just hands full. So they did not have space for the customers to come in, and probably they did not even want such profile of customers to coming and queuing up. So we tried becoming an PC at that point of time, and we were not allowed to become PCs for whatever regulatory purposes at that point of time. We kept going. Obviously, we never had a clue that at some point of time, others may have an opportunity to operate a banking platform, so to bank. So we went through this phase of not enabling the customer, and many times we think that how come these customers would save, and even customers don't believe that they can save and borrow at the same time. When you ask them how much can you save in
Bhaskar ji, can you speak up a little bit, sir? I think we're straining to hear you.
Is it clear now?
Yeah, it's slightly better.
I think I'll get over to try the audio. So when I tried opening an account, the question to the customer is that how will I save because I'm borrowing? But that's still true for that segment. It is actually as good as for our segment, where we also savers, we are also borrowers. We borrow for a different purpose, we save for a different purpose, and both of them does exist together. But for the customers themselves don't really believe that they can save because they're borrowing. So it came down to a point where we kind of, the question of how much can you save in a month became how much can you save in a week to how much can you save in a day. When you break it up, the customer says, I can save 30 rupees, 40 rupees in a day. But multiplied by 30, they can't save 1,200 in a month. So what it really says is that if we are able to take the trickle out, from them it becomes a saving, left to them it becomes an expenditure. That was the thought process really when we went. Another equally important one is that if we're able to balance both, they're able to kind of enable the customer save and enable the customer to borrow, then that's, I think, is true financial inclusion. Come to a point where they feel that they are far more financially stable, which itself changes the risk profile in terms of they behave towards the repayment of a loan. So this was the thought process that went on, but obviously kind of a few bank licenses at best were given to the people. First time when the differentiated banks, all of us didn't know how many licenses, in principle licenses would be given. So 72 of us, I think, applied. And it happened that 10 of us got an in principle approval. 8 of them happened to be microfinance institution. Probably connecting the dots backward, it really does make sense because starting up a greenfield venture in banking, the first thing you make money, as even the fintechs have realized now, you can make money only on the lending side. On the other side of the payments or the savings, in terms of balancing the customer relationship. So, but is the question that easy? Probably women should be able to answer it much more deeper. So NBFCs have got unique advantages. One, they are light touch regulated. The cost of compliance for a bank, with respect to the size, is immensely high. The cost structures in terms of IT, cyber security, so much to go. So probably none of us at that point of time even have an idea what it would really take. So kind of got an in principle, which is when we realized that the transition into a bank is not an easy one. It's not just opening up savings account and current accounts and doing it. Cost of compliance, the investments that are required. We also realize that it's a much more long haul game than kind of an NBFC. As an NBFC, we knew how to break even in a branch in 3 months' time. As a bank, it takes from 3 months, it goes. However, in the medium run and the long run, they do believe that if I have to go back and say, would you have still applied if you knew all of that? Probably the answer is yes. They've touched the last mile in terms is a very key thing in terms of strengthening the overall platform. Especially on the customer side, more you see the flow of the customer, which leads to flow, to understand the customer far more deeper and hence able to roll out products. Like say we have opened up a 4 lakh customer of ours who are microfinance customers, small ticket OD between 5,000 and 20,000. I, as a banking customer, salaried person for 25 years, I still don't have access to in terms of a voter personal purpose. So those are the enablements that the bank can give. But however, the path to becoming that is kind of a pretty challenging. Stop here and go.
Thank you, Mr. Bhaskar. And how was the journey? You know, everyone speaks about the glory of being a bank, the honor of being a bank, the halo around it, but it's not so easy, as we all know. So there are multiple, challenges that come. Firstly, deposit mobilization, complying with CRR, SLR, which are not, overhanging issues with an NBFC. So would you like to speak a bit about, the challenges that were there when you actually converted into a bank, and what, why it made sense for you in retrospect then?
Yeah, you're a very large institution in NBFC. The added complexities in terms of large CRR, SLRs to maintain, is the cost of funding in a different. More specifically, earnings out of SLR is far more lower than the cost at which you are. Then it becomes a. What happened is for all the 10 of us, many of us were at 1,200 crores in terms of asset size, and probably the largest at that point of time we would. So probably the challenge of converting and kind of doing an SLR was not that insurmountable as would be for a very large institution like say Shriram. So probably that was the benefit that we had. I would say that thank God we are smaller, it became a lot more easier. However, what should be other challenges? Some of the challenges you think that you're able to becoming you got probably thought the only two challenges were how to get deposits and how to manage technology. As you entered, we kind of had to meet with demonetization. And suddenly one day, plus 1 day, the challenge became complete on the asset side. So the other two challenges, which should look like challenges, then became far more manageable. So that's how I think of what you think as challenges and what I think as I say. Discuss what is left on the table after you think you've addressed all. Similarly, on the challenges front, I think, I'm sure I can broadly speak for all the 10. So we listed our top 2 challenges as how to really kind of have a branding, why will people put their deposits, are you a cooperative bank, because we like to have a moniker of adding a small finance, everybody, including the closest of friends, get confused that it's a cooperative bank because they don't believe that actually you have become a promoter of a bank. So it's simply impossible, and hence they thought it should be a cooperative. So those are the softer challenges were as much as intense as the hard challenges.
Very nice. Thank you, sir. Mr. Amish, would you like to comment on whether Shriram, on your thoughts or STFC's thoughts as to whether it makes sense for you to convert into a bank or whether you're aspiring to do so in the future?
Yeah, thank you. I think Bhaskar already answered that question. He is right. A large NBFC have its own challenges because you already build a culture, you already build a particular asset classes, you already build a customer base, and the approach which NBFC has for especially large NBFC, specialized NBFCs have are difficult to convert themselves into a bank unless the regulator wants a particular part. If they give a particular part, and then probably yes. But given a chance, I think it is almost an impossibility for a large NBFC to convert itself into bank. If you are small, maybe yes, you try, build, and then slowly emerge as Sarvodaya and others along have succeeded in the last few years.
Thank you, Mishi. Lovely. So we've all heard about the benefits and the pitfalls of converting into a bank. So now, I mean, let us go to the next topic, which is actually NBFCs driving financial inclusion in India. And there are 2 sides to it. Obviously, there is the asset side and then there is the liabilities and the wealth side. So I would, on the asset side, we have the honor of having Umeshji's vast experience in SME finance, especially secured SME finance, as well as vehicle lending. So I would invite you, Umeshji, to share your thoughts around, how you see the landscape of New India panning out in terms of, assets or loans to the financially excluded population or to the hinterlands of India.
Yeah, thank you. See, basically, most of the NBFCs, they are asset-backed lenders. And if you look at microfinance or cooperative banks or small finance, they tend to lend to customers. So there is a difference. And we specialized into assets like gold, vehicle, LAP, and SME. And even in the SME, it is not normally a working capital finance. It's again some buying of a machinery or buying some assets. So we build a specialization based on the earning out of the vehicles, assets that brings it to the customer, and that cash flow, how we can pay. So that's how we manage the business, or that's how the NBFCs have built the business. So NBFC will keep doing that because now you imagine a vehicle finance. No, most of the new vehicle finance are done by bank, but used vehicle finance are done by the NBFC. Now, what happens is banks, based on the invoice or customer's track record, they lend. They don't really understand the depreciation application of the vehicle, and then they lend. So therefore, we have specialized ourselves into used vehicle financing, because what happens is life of a vehicle is 15 years. It goes on hand. Maybe urban people buy it, then it goes to semi-urban, then it goes to rural. By the time it travels, it goes into a different hand where the track record may not be established. But based on the ability of the asset class that can earn, and based on some inputs on the customer's track record, we lend. So that's how each of these NBFCs have specialized over the period. And I think there's a lot of scope for the NBFC to keep continuing to do that, including at tractor financing. It can be even three-wheeler financing, because as we go deeper into India, you will find that most of the assets are either second hand or without invoices. So you need to establish the value of the asset and the depreciation and cash flow out of it, then lend. So this requires a specialization. Banks, when they are having so many other activities, they find it difficult to build a specialization into this kind of minute changes happening to the asset classes. I think, therefore, the NBFC will continue to play a major role in financing, acquiring assets. See, ultimately, our job is to make customer acquire an asset, earn out of it. Then, as he specializes, he keeps buying other assets. So it's not that he ends up with one asset. One asset he buys at the end of 3 years, the matter is over. No, he buys second asset, third asset. Sometimes he buys new asset. So person keeps adding the assets which he has and build business over the period. So that's why I think NBFC will continue to play a major role in India. And it is not only in India, I think even in the international scenario, I have seen many of the asset financing is done by the specialized credit agencies. There may not be word NBFC other part of the world, but you also you have credit agencies which makes an assessment and lend.
Absolutely, thank you. And what is your view to customers who are NTC or due to credit? So how do you tackle that segment? Because that's the large customer segment that is now coming in to the formal banking fold.
I did not get you. What's that?
And what are your thoughts, Rameshji, on the NTC customers or the new to credit customers, the people who are coming into the banking fold who do not have established credit histories? So how do you tackle that challenge when you're going to the hinterlands? And secondly, I think one of the biggest problems, right, in pursuing a rural lending business, right, is also staff motivation, because those people really have to spend a lot of time, on the field under the hot sun, slaving away. So how do you keep your people motivated to do this? And what are the strategies that you're using, or you think the dominant factors when as India makes its leaps and bounds into inclusive banking?
Yeah, that is actually an opportunity for us. A typical banker would not like to soil his hand. I'm not talking about a small finance bank. I'm talking about a general bankers, because they do not wish to, because bank as a definition means a place of a transaction that happens. It is not going to the field. The NBFCs build a specialization by going to the field. The asset verification, customer verification, asset application, all those things are done in the field. So the very job of an NBFC and executives of the NBFCs are always on the two-wheelers. They are mobile, they are on the two-wheeler, they go to the field and they talk to the customer and they understand the application of the asset. And as you rightly put it, the assets, they keep moving from urban to rural area as it depreciates, because rural area, they will not be, or they may not have enough capital to buy new assets. So they buy a second-hand assets. So therefore, the scope and opportunity is much higher in the semi-urban rural market. And that's where the opportunity and the forte of built the base over the period. And as you rightly said it, yes, now banks are reaching to the rural market, and they have more better track record, or they have known track record of the customer on the field. But the challenge for the bank is most of the transaction, even today, it doesn't go through bank. It happens in cash. For example, you take a tractor, for example. Now, tractor is hired by a farmer from a tractor owner, and per hour basis or per day basis, he is paid some amount, and that amount is in cash. So the earning of the amount is in cash, and it is difficult for a banking system to make an assessment or make a credit judgment based on what is happening in the cash. So most of the fruit, vegetable, or the grains that moves in the rural area, most of the activities in the rural area, or even in the urban and semi-urban area, most of the small transactions happens in cash. So therefore, there is no trail. There is no banking trail for bankers to establish a track record. That's a challenge. And without having a track record, banker to lend becomes a challenge, because bank being RBI would like our banks to have a proper track record of a customer before lending. So therefore, banks will be habituated, or banks will be forced to lend based on the past experience and based on the trail and the transaction that has been recorded in the system. So absence of that, the banks would find it challenging to lend aggressively in the to a small ticket, especially I'm talking about small ticket. So NBFC will have its own way to assess the income levels based on the vehicle or the asset earning capacity, and they make maybe a Excel sheet formula of earning, and then they lend, because for them there is an asset to repossess back. The strength of the NBFC is value of the asset behind, so not exactly the customer's track record. So bank how to depend on track record, and NBFC depends upon the asset value. So therefore, there is a scope for both of them to be there, and it will take a long time for banking system to lend to this kind of lending.
And how are you harnessing technology, Umesh, to ensure that you reach out to the masses?
See, the technology is very simple now. Anyone who has a mobile is digitally empowered. So he can make the payment, he can receive the payment on a mobile, because the payment gateways are available to everyone. So I'll tell you an example. Around 8 years back, when I hired a vehicle as a taxi, I asked him, I did not reveal who I am, and he said he has taken finance from Shriram. And I have a difficulty in making the payment, because all the time I'm driving the vehicle, and in the office works between only 10 to 5, and I'm not able to deposit the money, my installment amount, in time. Then I told him, why don't you call them? They'll come and pick you. No, I'm always driving from one end to another end where to call. So if at all they provide me an ATM to put the money in the night, I would be happy. Then after 8 years, we made a lot of payment gateways. We have today app which provides all payment gateways that enables him to make the payment. After 8 years, I asked one of the customer, how is your repayment? How are you making your repayment and all? Then he said, some apps are not easy to deal with. And he gave me an example. Say Google Pay, if I'm stopped at the signal, and in the signal, the 2 minutes is sufficient for me to make the payment from a Google Pay. But not the same with the Shriram app. Because I revealed my name, he told me Shriram app. The technology team, that this is the difference between a Google can bring in to give that kind of a facility to a customer in a quick seconds, he can make the transactions. So there is so everyone, whether it's a bank or NBFC today, they are digitally reachable or digitally enabled, and we always wants to give solution to customer on a digital. But the the technology or the strength of the large players like Google, that we may not be able to match. But technology is a must. A digital reach is a must for any NBFC or bank today.
Absolutely. Thank you, Meshi. Bhaskarji, would you like to comment on the asset side or any of the points that Umeshi raised, especially the fact, I think when he said his comments about the banks, which were very right, they were more focused on the traditional banks, but I think the small finance banks are much more nimble in their approach in going to the customer and going out into the field. Would you like to comment on that?
Yeah, I think as Umesh rightly said, I think the SMBs are not the same way as banks, kind of qualified with a caveat. So the advantage of probably a small finance bank is that you transition from an NBFC. So they say that you can't just roll up your sleeves, you better wear half sleeve shirts. So that's the way kind of necessarily operate. But there is to a point where, as Umesh was mentioning, what the forte of NBFCs were in terms of looking at new to credit, assessing risk in a very different manner as otherwise the bankers would do, is slowly kind of giving way, and there is a convergence. And that convergence means that no, you kind of want to take call as more and more data is available. We realize that the -1, which is the customer without a track record, obviously you do a little bit of a credit analysis, is actually as good as a customer with a credit score of 700. The marginal deviation. However, as a customer kind of takes a credit, they don't really prove themselves well, and then you kind of see anything less than 650, 600, then there is a big divergence which comes in terms of the credit losses from those segments. And as rightly mentioned by Umesh, I think that's a very, very serious but amazing point. If the banks or NBFCs have not made their life of the customers as easy as it can be. We kind of make it complicated. One simple reason is that if you are the customer of a bank, any bank, want to transfer money to the customer in the same bank, you will have to go through the registration process of key in the account number and so on. But you can do the same from Abhishek as a customer of A bank to Bhaskar as a customer of the same bank. You use Google Pay, you can do it in 3 seconds, 5 seconds, 10 seconds. So we have not made the customer experience fruitful enough for them to kind of become digital, be it an NBFC or a bank. As we do it, you will realize that the customers, majority of the customers, even in the low-income households, have become digitally included. Not necessarily the customer or my customer or Umesh customer, but certainly the son and the daughters are very conversant with the Google Pay or a Paytm, and many times they become assisted, but assisted at their household level. So there is a convergence happening. Certainly that there are spots which NBFCs will continue to do, but with the well-managed large NBFCs have access to the same cost of funds, marginal basis points here and there, and kind of that's an advantage banks have. They also kind of have a reasonable. And in terms of credit assessment, certainly there's a lot more flexibility to an NBFC, which enables them to look at various segments in an innovative manner. Banks will have to really catch up, but the digital evolution will make that convergence much faster. There's no more just you'll have to go and do it physically. I can roll out a digital tool where the customer of Shriram, as long as he has got a track record, I can give the entire loan on a pure digital basis without even meeting the customer. That I think is really happening as fast as the WhatsApp revolution happens a couple of years back.
Lovely. Thank you for your thoughts, Umeshi. Bhaskarji. Bhaskarji, would you like to comment on the other side of the puzzle, which is the non-asset side, which is the liabilities, the wealth, the insurance part of it?
Asking me?
Yes, Bhaskarji.
Yeah.
I'm saying as a bank, most NBFCs are fully focused on the asset side because the liabilities typically come from either NCDs or bonds or bank borrowings, etc., or commercial paper. But as a bank, I think there's a huge focus on the liabilities side to give a holistic banking experience to the customer. So I think a lot of focus has happened on the asset side, in India, given the NBFC framework. But the small finance banks are really leading financial inclusion into the liability side, the wealth piece of it, even bank insurance piece of it. So would you like to share some thoughts with us about the other side of the balance sheet?
Sure, Abhishek. I think when the moment you use the word wealth, then I think the whole way in which we look at it really shifts to upper middle class and above, right? But certainly, I think now we have 15 lakh customers from 15 lakh households approximately. It's usually a 1:1. What you realize is that many, I would say closer to 99% are not covered even for the basic insurance, which means that the PMJJY, which is available at 330 rupees, the coverage is so low, and many times it happens that probably they have taken, but they've forgotten that they've taken. Even in case of an unfortunate death of an insured, the claims ratio in PMJJY is so less. What the government thought would be a very loss-making proposition for the banks, the claims ratios are so less, probably because people take and they don't really tell the family also. The basic thing which we are really focusing in terms of can we really make sure that forget about the cross-sell, which is a fee-based income, but prior to that, look, can you do these basics in terms of PMJY, PMSBY? You don't really get paid for it, but what happens in indirectly that as long as the customer is substantially better off, minimum insured to the extent of 2 to 3 lakhs, what we take as credit cover is in thousands, is in 30,000, 40,000. Put it very bluntly, it doesn't even cover the funeral expenses. We have to go beyond, and for that doesn't really mean that we have to really sell products which don't really fit in. Basics are PMJJY, PMSBY, recurring deposit. Once they come through it, then you take them to the next level, which could be a small SIP of 500 rupees and 1,000 rupees. So wealth management or building wealth, I would put it as management. Building wealth for our customers starts with actually making it very simple. A product where the customer will not come back to you after 1 year and say, you sold me a product which I didn't really require. I think that's an endeavor that we take. And as a customer graduates, your ability for you to make quite a bit of money in a manner which the customer is happy, you're happy, is tremendous. I think the 15 lakh households, statistically speaking, is actually 1 out of every 200 households in the country is our customer, at a size of just 4,000 crores in terms of asset size. So that's a potential, but doing it, execution on the liability side is far more difficult than step on the door in terms of doing asset product. That converted, what you will have to attempt as you are now 4 to 5 years old. The first few years went in terms of liability as a separate set of customers, asset as a separate set of customers. So, but banks worldwide has proved, including Grameen Bank, that there is more deposits to be mobilized from the same set of customers. And the hypothesis that the borrowers don't save is not true even for low-income households.
Thank you, Bhaskarji. And it's interesting to note that, people like Zerodha, Small Case, people like, Paytm Money, they are leading the inclusion even on the demat account. So the record number of demat accounts have been opened in India in this calendar year. And there's a lot of new money, especially from the millennials, flowing in to the segments wherein people are really investing small ticket size savings of theirs. And even on the insurance side, the foray is to go vernacular, is to go to the hinterlands where they can distribute both life, health, cattle, crop insurance products. There's a lot of action which is happening around that segment as well. So we have assets, we have liabilities, we have insurance, we have wealth, or rather small wealth, I would say, small ticket size wealth. What about geographical focus? Umeshji, how are you thinking of really penetrating the more difficult parts of the country, like Northeast, Jammu Kashmir, Andaman, Lakshadweep, the basic, the excluded parts of the country which are more difficult from a terrain or geography or a political perspective as well?
Yes, see, you are right that a place like Northeast and all, people would hesitate to go. And in fact, we went into Northeast around 15 years back. Today, we have around 60 branches in Northeast. Even in J&K, we have 10 branches. So we are doing quite well. I feel our experience in Northeast has been extremely good. Of course, there also you have some regions, the regional imbalances within the Northeast you will find.
Yes.
You will find Tripura being the best, and the Mizoram being the next. People would have felt that Assam is the best, but that's not the correct picture. because even 1 week back there was a Niti Aayog came out with a report on the Northeast, and it also gave same result. They said that human index development, the Mizoram and Tripura were the much higher compared to Assam and other places. Of course, there are difficult terrain like Nagaland where we have not ventured into, because Nagaland there is always a parallel government running and it's difficult to get into that place. But J&K has been quite good, even though we had certain challenges in Srinagar in the past 1 year because of curfew. But our experience has been quite good in the Jammu and other part of Kashmir. Only in this valley, Srinagar, we had certain challenges, but other part of Srinagar has been quite good. So there is enough scope and opportunity, but only thing is we need to build local team. There's no point in sending people from other state or other place to these areas, because you need a local team, local leader. Once you get a good local leader, then it's easy to build, establish, and because we have to understand culture, we have to understand the local what you call ethics or their morals, whatever they believe in. We can't just put our standards there. It's not that simple. But I feel the result have been quite good, and we are confident that going forward we will do much better there and penetrate much better into almost all geographies, which we earlier would have delayed going there.
Thank you, Mesh. Bhaskar, would you like to speak about some of the innovations that Suryodaya Small Finance Bank has done, in banking to basically reach out to the excluded segments? Any thoughts around, the innovations or, pioneering products or processes?
For instance, our entire micro banking or inclusive finance, as we call it, is completely digital. We don't really take a piece of paper at all, except for DPN, if you can call it something. Earlier, the entire turnaround time used to be you complete all the regular process of getting in touch with the customer. From the time you get closure to the time to disbursement would have been anywhere between 7 to 10 days. Today, as it gets over, it happens on the same day or the next day. The speed is one which has happened out of Aadhaar, mobile, the jam, that I think has made it a lot more easier. When we entered the pandemic, we kind of realized that doesn't mean, on a general hypothesis, that since the customers are impacted, they're all queuing up to take a loan. But where access to credit gives you a safety net, and you may not need the money there. In a microfinance entirely is that when you are ready, when the customer is ready, when the funding happens. So it's on a batch process, it's not on a continuum. Introduced to 4 small ticket overdraft accounts for the customers during the month of April, May, June. Is that all that the customer will have to do is that visit them once, and they'll have to give a consent and set up a limit, and they can go and draw out their money and pay interest only to the extent they utilize and to the extent that the number of days they've done it. On a standalone basis, it will be very, very difficult, very expensive. Even if you charge 40% interest, it will still not kind of break even, because somebody takes out 1,000 rupees. Even if you charge 4%, you're talking about 40 rupees in the entire month as interest. And then you talk about an ATM withdrawal charges, servicing, and all of that. So we kind of rolled it out for all our existing customers. So the cost of servicing becomes incrementally very close to zero. Can't really say it becomes zero, but very close to that. So having set up the limit, we realized that I think makes the bank account for more transactional. Now we are working on a project where these customers, if they want a two-wheeler, if they want a small ticket micro home loan, as we call it, have a pre-approved. The customer's experience will be far different and far better than probably you and I will have replacing a home loan institution. So if you make it, I think Umesh also rightly said, it just happens ironically, it's counterintuitive, which the lower income households or the emerging class transact has to be far superior to the convenience that you and I will get from any app. And it has to be so digitally safe that one transaction for 25 rupees fails and you're not able to address it. Actually, you're putting them off for a couple of years. They will never do it. So it could be as low as a 50 rupees. It's not the quantum of the money. It's just the trust in the entire process breaks down. And our complaint resolving process in financial services is very complicated. kind of true for probably our bank as well, is that if you want to do anything, everything is available in the app except for making a complaint. You can't just click that and then put a complaint and it gets addressed. So you have to really ensure that the railings that you build for these emerging class has to be far more superior. The customer complaint handling system has to be proactive than reactive, solving what comes rather than getting into the root. The small ticket OD really kind of helped us to kind of look at the potential that exists without even stretching the credit risk profile, but enabling customers to transact. Once that happens, what you really see is that you kind of have a far more stickier relationship. You're able to understand them much better. And if that 95% of the customer turn out to be good, you can build quite a bit of the product on those 95. So the opportunity for innovation is so large, but however, I think each institution have to take care. You do few where the customers love rather than doing many where the customers will like. It's so tempting that you can do all of that. I can get into used vehicle funding. I can do this, and everybody can do everything. But I think each one will have to play their niche very strongly, and that's probably one reason why Google Pay has become so popular compared to some of the payment apps. You ask the question, why? It just is so simple. I think simplicity-driven, safe digital inclusion is what we are focusing on, but a few, but do it well.
Thank you. Thank you, Bhaskarji. I think that's a wonderful initiative that Studiodaya SFB has taken. Best of luck and best wishes for the same. I think we are pretty much out of time. So, Umeshji, any parting words from you?
Nothing much to add, but I feel we have a long way to go in India. There are so many pockets which are not reached. So there is enough scope and opportunity for everyone to go deeper and thrive. So I feel even if the digital divide or sophistication wise, I think everyone will come close, and we play a complementary role, whether it's a bank or NBFC, large or small, all will play a complementary role. There is so much of opportunity for everyone to contribute.
Excellent. I think it's been a wonderful afternoon discussing with Bhaskarji and Umeshji. We've gotten to hear a lot of good points about how next foray of banking will move from the focus will move from India banking to Bharat banking, really. I would like to, because we're out of time now, I think I would like to thank panelists for joining in. And again, a lot of thanks to ICC, Ratish, and the entire Western Zone team for managing this, for organizing and managing this banking event.
Thank you.
And thank you very much, Bhaskarji and Umeshji, for joining in. And thank you very much to each one of our participants for joining into this conversation.
Thank you, Mr. R. Bhaskar Babu and Mr. Umesh Revankar for that wonderful time and those insights. Thank you, Mr. Abhishek Fogla, for managing this session very well. We'll take a quick 2-minute break so that the next session panelists can prepare themselves. We'll be back in 2 minutes.
Thank you.
Thank you.
अब मैं देखूं साफ बारिश के बाद हट गई रुकावटें राहों से आज अंधेरा दूर हुआ हुई नजरें साफ जीत का विश्वास हर दिन
ट्रांसपोर्ट फाइनेंस, जैसी आपकी जरूरतें वैसी हमारी फाइनेंस सेवाएं।
मंजिल मिली है जिसकी थी तलाश जीत का विश्वास हर इंसान।
श्रीराम ट्रांसपोर्ट फाइनेंस, विश्वास जीत का।
Welcome back. We'll move on to the next session, session 3, that is, can bad banks resolve India's NPA problem? This panel will be chaired by Ms. Jaya Vaidyanathan, CEO, BCT Digital, and will be joined by Mr. R.K. Bansal, MD, Edelweiss Asset Reconstruction Company Limited. He'll be joining in a minute, Ms. Jaya. Mr. Abhizar Diwanji, Financial Services and Restructuring Advisor, ENY, and Mr. Pallav Mahapatra, CEO, ARCEL. Over to you, Ms. Jaya.
Thank you very much, Ratish. It's a pleasure. It's a pleasure chairing this panel. And as Ratish mentioned, the panel is on can bad banks resolve India's NPA problem? It's not a $1 million question; it's a $1 billion question. And let me tee it off by asking a question. Our Raghuram Rajan, in his book "I Do What I Do," mentions that the idea of a bad bank is just shifting of bad loans from one government pocket to other. As you introduce yourself, maybe you can also tee it off by asking, what are your thoughts on this? Maybe Mr. Should I start with Abhizar Diwanji? Can you please take the lead and talk to me about the controversial topic?
So I, of course, you referred to what Raghuram Rajan said in his book to say that's the only way of slashing away assets from a bank into another entity and then forgetting about it. I think that would be a very, very naive view about it, in my view, because really, one of the objectives that the bad bank aims to solve is the fact that we have disparate bank holdings. So every corporate in India, on an average, banks with 10 to 15 banks. And imagine trying to get 15 people to agree to one resolution. It's almost impossible. So one of the achievements of the bad bank is that it gets all these people together and all these exposures together so that there is one decision maker for that asset. And I think aggregation is a very important element of what the bad bank will end up achieving. One is single decision maker. Secondly, singly aligned interests. Sometimes when multiple holdings are held by multiple people, there are different interests that different people have, and not all of them move in the same direction. So I think that the purpose of aggregation that NARCL is expected to achieve, I think will go a long way in resolving assets.
Thank you for that. Mr. Mohapatra, your opinion on that? Are you in agreement? What challenges do you see going forward? If you can expand a little bit on that, that will be great, because you've been on the bank side and you've been in this new role, and there's a lot going on both sides of the table. Would love to hear what your thoughts are. Sir, you're on mute.
Am I now audible?
Perfect. Yes.
Thank you. So I totally agree with Mr. Abhizar that the main weakness in the entire process was non-availability of the debt aggregation. Now, the concept of debt aggregation, okay, it appears very simple that if the resolution is to be done, then there has to be one decision maker who should take a lead. Normally, it is said that the consortium leader will take a lead, or in case of multiple banking, it is said that the bank which has got the largest share will take a lead. But on the ground, because I was a part of the banking system, on the ground this doesn't happen. Now, even if suppose there is an entity called ARC, which has been created basically to address these issues, they go and basically acquire the assets or the debts from different banks. It has been invariably seen different banks will have different approach in selling the debts or assigning the debts to the ARC. So if the ARCs, and what happens is that ARCs keep on, I will say, acquiring the assets. I will not use the aggregating the assets, because in very few cases the ARCs have been able to aggregate the assets. They keep on acquiring the assets over a period of time. The period of time can range from 6 months to 3 years. So think of the asset, a part of the asset or the debt which has been acquired from Y Bank in the 3rd year. What is the price of that? And for the 3 years, there has not been any sort of resolution process which has been started. So 3 years period has been wasted, and it's a very long period for in case of the resolution of stress assets. So this is one point. And why some of the banks do not basically agree on this, I have no idea. As a banker, I can be very, very blunt and upfront that why they don't do it, I don't know. Because they should realize one basic point: there is a time value of money.
Yeah.
If the decision is not taken today, it is going to harm them, no one else. So this NARC, after being basically enacted with the government ordinance, that will play a big role in the aggregation of the asset. And I hope, since there will be a mandate, and there is a mandate, and these public banks have put the capital, so they will basically sell the debt to their national ARC. Now, there are some technical points which Mr. Abhijay may be privy to it. I am not privy to it. As to whether there will be a price discovery mechanism, I don't know. Even if there will be a price discovery mechanism, whether through the open auction or through the Swiss challenge, then how the level playing field will be created, I have no idea. Similarly, if normally in case of wherever the SRs are issued to the selling bank or to the co-investor, there is a concept of some fees being recovered by the ARCs. Now, because they are providing a platform for doing this these resolution, so there is a fees. But when the public sector banks, when they sell, and they basically are issued the SRs, whether they will be paying any management fee or not. So these are some technical points which most probably Mr. Abhijay may be privy to it, may be knowing about it. So that is one part. The other part is regarding the creation of AMC. Now, what I understand, I'm not as expert as Abhijay, what I understand that world over, wherever this bad bank was created, there was only one entity. And that entity used to basically buy, and they used to resolve. Now here there will be 2 entities. Now, in case of the 2 entities, one entity will be basically putting the money. That is the national ARC, whatever is the money, 15% or net value of asset. The other entity will be doing the resolution. Now, normally it is said in the finance world, there has to be a skin in the game. Then who has got the skin in the game? So these are the technicalities. Most probably these are being worked out. But on the matter of principle, I totally support this concept of national ARC, because if the debt aggregation happens, a message will go down the line loud and clear that everyone in the ecosystem, all the stakeholders, they mean business. No one can take the entire system for a ride.
Thank you very much. We also have Mr. Bansal online now. Mr. Bansal, would you like to add to it? I'll just give a minute or two. Maybe if the video doesn't come on, we will switch to the next question. Mr. Bansal?
Yeah.
So the question was again more about, do bad banks really work, or is it just shifting money from one pocket to the other? So that was what we were talking about.
So I hope you can hear me.
Absolutely clear.
So, okay, I will not call it bad bank. So let me call it national ARC.
It's good bad bank.
So it's a good move. See, let me start with the as per theory. What is ARC can do which bank can't? I mean, what ARC can do which bank can't do?
Yeah.
So technically, there are 3 things what ARCs can do. Otherwise, the banks will not sell the assets. course, their main purpose is to reduce the NPA. But the three things, one is that they can do the aggregation. And this national ARC, as Pallavji is also saying, basically the aggregation is a one plus point of national ARC. Because we have seen this problem even in intercreditor agreement, that banks don't reach a conclusion or consensus. So that is one advantage. The second advantage which ARCs typically can do is a restructuring, which banks find it very difficult to do restructuring in NPA accounts. The third is in NPA accounts, sometimes additional funding is required, whether it's a last mile funding or working capital. And we have done a number of cases like that, which ARC can provide or arrange, while banks find it very difficult to give any fresh funding in NPA account, because this will also become NPA. So these are the three advantages of typically ARC. Now, national ARC, how many things out of these three can do? One, they can do aggregation. Anyway, they start with aggregation. Basically, whether they can do restructuring, yes. But as I company which is supposed to be there with the India Debt Management Company, which may do the restructuring, or third part is the press fund. I think that part is still not very clear whether they will be able to access funding, but hopefully, if they really want to do a resolution, they should do. So that is the positive point. I would say implementation is the key. So how do you implement? How do you resolve all these cases? First of all, let us see that most of these cases are quite old. Banks have not been able to resolve these cases, and they are just trying to transfer these cases, which are virtually zero in their books because they are fully provided. And if they could not resolve in 5 years, I don't know what they will do in future, but at least a good warehousing concept. The other advantage of this is that banks otherwise find it difficult to sell to ARCs or somewhere else because of the other regions, CVC, etc., etc. This is government entity indirectly, so I think they will not have that worry. So that's the one positive point. But later on, what they do, because they will find a resolution is supposed to be done by the private sector company. So I hope they will not get worried about CVC, etc. The only two point which I feel is this is taking care of only above 500 crore. The other negative feature is that they cannot buy, as being an ARC, they cannot buy the cases which have been declared as fraud. And unfortunately, in banking system, a lot of cases have been declared as fraud. So I think there is a request now made to RBI to allow that. So if that comes through, maybe it's a positive factor. Otherwise, a lot of cases are not coming actually in this list because of this fraud element. So I think otherwise it's a good move. Only thing is that it's technically banks are only giving equity, and then that is being paid as 15%, which will be shown as profit. So technically you are converting capital into profit, which I don't view, but it's a good for the country and good for the banking system. So I think we should welcome this.
I think I often say that NPAs happen for two reasons. One is the willingness to pay, and second is the ability to pay. Unfortunately, in India, the willingness to pay or the so-called frauds have kind of like the quantum of it has increased over the years, and we need to really step in and do something about it. My second question directionally would be, great inputs in terms of aggregation, decision makers kind of coming together, governance and principles around it. So what is it that we're going to do new in terms of not just looking at it differently and having a separate board, but some thoughts on maybe technology interventions that are going to help, new way of looking at old problems. It's kind of concerning because NPAs have, we have now said we're not going to declare how much the NPAs are increasing, till March of this year. But, data shows that it's increasing from 9.5 to 12.5 to worst case scenario 14.5%. So more and more NPAs are happening. And you need new methods of looking at NPAs to kind of solve the problem rather than just looking at it as a separate bucket. Although, there are issues of aggregation, decision making, etc. So maybe I'll go in the same order. Abhizar, your thoughts on that?
Yeah. So, as Mr. Bansal just said, these are old NPAs. The banks have not been able to resolve it. How do you look at the NARCL resolving them better?
Right.
So first of all, Jay, you're completely right. We need a very different approach to this. Now, what is a different approach? I will take it as technology and commercial.
Yeah.
Now, on the commercial side, first of all, we need to realize that this is not just a aggregated auction mechanism. It cannot be. So earlier auctions were conducted where multiple banks bid, and there was possibly one or two bidders going for it. The second leg is to say that not only do you aggregate, but because you are aggregating, you have the ability to enhance the value. Now, what do you do for that? First of all, the concept that I look at in all ARCs is something called yield contraction.
Yeah.
In a sense,
absolutely.
when you buy an asset, it's possibly a 20 to 25% yield asset. As in the riskiness in the asset is such that the capital that's put into that asset requires a 20% return.
Yeah.
25% return. Firstly, you need to remove the riskiness and increase the enterprise value. That's commercial. How do you do this? You basically make sure that you pump in enough interim capital to grow the enterprise value of that business.
Yeah.
When you grow the enterprise value in the business, you reduce the riskiness of the potential cash flows. And a 20 to 25% yield asset then becomes a 15 or 20% yield asset. 15% yield asset. When you do a 15% yield asset, you effectively double the value.
Yeah.
So that is one big reason that the NARC or the DMC that's going to be created for the debt management company needs to make sure that we create incremental value in assets where there is enterprise value. So first of all, recoveries will only improve when enterprise value improves.
Exactly.
There is no free lunch here. Nobody pays you more because you've lent 4,000 crores to the company.
Right.
Take the Siva example, right? The bid was 400 and the outstanding debt was 4,000. And the whole world is shouting around saying that why did the assets get sold at only 10% of the value? My contention to whoever shouted around is, please buy it at 400 yourself if you think it's that cheap.
Yeah.
The question is, the enterprise value at this point in time is 400. Now, the job that you have is to increase the enterprise value from 400 to 1,000 and then sell the asset. So ideally, what an NARCL DMC needs to do is to make sure that the yield contraction or increase in enterprise value needs to happen. Now, that can happen in many ways. Pumping in money, making sure you have control over the O&M of that company that you're running. The whole operations and maintenance of that business is done by you. Coming to your technology point here, it's actually creating the right dashboards.
Yeah.
Make sure performance is monitored on a daily, if not an hourly basis. And one needs to make sure that it is on top of the numbers. And that's only when you can work out a revival. I mean, we are currently involved, and I must tell you, in a large FMCG company, which is run very well, but they are not being run well in a crisis situation. And we have to work towards that company to conserve cash. Make sure that margins are mentioned well. Make sure every intervention that you do is quantified. And this happens only through technology. And we made sure that decisions were informed. And when informed decisions happen, you will find the company revives. So the only way, and I'm sure the gentlemen on the panel will agree, the only way to enhance value is to increase enterprise value. And if you're not able to do that, then no amount of DMC, NARCL, or even existing ARCs will help.
And it's also about how you're using technology. Is it only for dashboard and intelligent decision making, or about spotting issues early on?
First
It's
of all,
more about your sources of data. How are you tapping? The world is entirely gone big data. You have predictive analytics. How are you using a lot of those?
Absolutely. So that actually goes into, Jay, that actually goes into the dashboarding. But I'm telling you, more importantly, technology point that I missed out is that the industry may have gone through a technological revolution.
Exactly.
And are you, when increasing enterprise value, are we introducing newer technologies? And that's why your interim finance will get used.
Right.
Doing some of these interventions. And I think if you don't do that, you're not going to be able to recover. So I'll leave it to Mr. Mahapatra and Mr. Bansal to talk about it.
Yes, Mr. Mohapatra. Very eager to hear your views on this. Sir, you're on mute.
Now unmuted. Yeah,
Perfect.
Mr. Abhijay Saab is an expert in resolution, and we had a lot of interactions in the past. See, Jaya, when you ask the question of technology, I hope and I presume that this is not limited to an ARC only, because neither the government nor the RBI has taken a call that the existing ARCs are going to be wound up, right? So existing ARCs will remain. So first of all, as Bansal Saab was saying, so I want to make one comment on what Bansal Saab said, and it is with due regard to Bansal Saab. Please don't take it otherwise. Bansal Saab talked about that the matter has been referred to RBI, that the fraud cases should be also allowed or permitted to be sold to ARCs. I have a very strong different view on that. The number one is that if the fraud has been declared, maybe under the pressure, that is something different. But if we go by the definition of RBI regarding the fraud, it is malfeasance. Now, if the promoter is responsible or has committed the malfeasance and has taken out the money, whatever is the amount, out of the company, why the ARC should be bothered to basically resolve those assets? This should have been taken care of by the banks. And why, I won't say the sin of the bank should be transferred to the ARC. I won't use that word, but I'm a strong proponent that the fraud cases should not be allowed to be transferred to ARC. Number one point. And I know that there will be a different viewpoint, and I think Bansal Saab and I agree to disagree on this. That's fine. Now coming to the technology part. So the technology part, I will first go on the wholesale accounts, and then I will go on to the retail and MSME account. In case of the wholesale accounts, Jayaji, see, we go for the acquisition of those. The bank will come out with the auction process, or there may be a bilateral deal between the selling bank or selling NBFC and the ARC. Now there is a very limited time which is given to the ARC to do the due diligence, right? It may be 15 days, it may be 21 days. It is virtually impossible that they will be able to do the 100% due diligence on that. Normally, the ARC, what they do is, they have a board approved policy that this percentage will be done 100%, and the remaining will be done over a period of 3 months or 6 months. How the technology will assist? Now, there are a lot of fintech companies which the ARCs can partner with, or they can basically buy those solutions, which has got APIs.
Yeah.
And these APIs are with wherever there is a the computerization has been done in the sub-registrar office, wherever the computerization has been done in the courts. So the data is collected from there, and the ARC knows a part of the information is already available to them. ROC cert, all those things, and even the credit bureaus, and also the side, and also the rating agencies. So just think of how, with the help of the technology, when these fintech companies or the ARCs buy that particular platform, how this will help in doing the due diligence, both the legal due diligence and also the physical due diligence. Now coming on to the retail side, normally in case of retail loans, these are not sold or acquired by the ARC on individual case basis. Mostly these are done in the portfolio. The portfolios can be 25, 30, 50, 100, 150, depending on the deal between the ARC and the selling bank. In those cases, what I strongly believe that 80% of the job should be done through the technology and 20% should be only manual. And this is possible. I have talked to many fintech companies. They have end-to-end solution. This is on the acquisition part. Now coming to the resolution part. Now what we do is, we are also acting like a bank that we will go for the SARFAESI action, we will file the OA in a DRT, or in case of the wholesale accounts, we will go to the NCLT. Now, whether there is an artificial intelligence, which is giving us some predictive analysis, which account to be done what? Of course, this will depend on the business rule, whatever we feed in the system. So this way, both on the acquisition and also on the resolution, technology is the future for the ARs, I'm telling you. And in case of the retail and MSME, that is the only thing available.
So we do actually have, I mean, coming from a fintech perspective, we use a lot of sense and response. And when we say sense, it's newer sources of data, a lot of artificial intelligence, which does pattern matching on predictive analytics basis, and also gives a corrective action kind of thing, alerts, resolution, library of triggers. And that's something that I think is increasingly going to be the wave of future, as you said, in retail for the bulk part, but also in terms of wholesale, a lot of lead indicators that go into positive structuring kind of a contract. So thank you for that. Mr. Bansal.
Yeah.
Also on the topic of, do frauds really, should they be included?
No, it's okay. Let me just clarify. I don't have any disagreement with Pallavji, and I can't have a disagreement. So in fact, what I was telling was, IBA has requested RBI for NARCL. But as an ARC, so I am not in favor. But I have written to RBI that some banks take liberty of declaring the case as fraud after selling to ARC. I have objected strongly to RBI that they can't declare it as fraud, or if they are declaring it after sale, they should take it back. But they are not doing it anyway. But they are big brothers, so I don't want to comment on that. So, but IBA has requested, by the way, for NARCL. Right. So not for our ARCs. Now, let me come back to technology part. I will take the question in two parts, and taking from Abhijar. In wholesale segment, technology, what you understand from that perspective, you are mentioning fintech and all that. So maybe there the technological part is much less. You have to understand that technology plays a big part there in the whether they are using latest technology, whether ARC is helping them in that. By the way, our ARC is one which has a turnaround team, specialized turnaround team. We have helped at least 3 big cases. Example I will give without naming them. Like say one port we took over and we allowed them to do mechanization, automatic mechanization. That helped the company to actually increase the value. So basically, it's a question of enterprise value enhancement, what Avijay said. There was a paper plant which when we acquired, it was making losses. Today, it is making a bit of 700 crore per annum. So by we fuse working capital, we allowed them to do capex, everything else. Similarly, a lot of such companies we have allowed them to get the latest technologies, and we monitor their performance. We use our turnaround team, and today coming from losses to positive EBITDA of 700 crore type. Similarly, like say real estate project in Dadar, we arranged 500 crore last mile funding, and today the building is complete. You might have seen it somewhere. It's a Inur project. So today the residential building is complete, and the commercial part is complete. Just got OC for 40 floors. So basically, you have to see how can you help the enhancing the value and the enterprise value. So if you do that, then only you can get better returns. We provided interim finance. I think we are one of the entities which have provided interim finance at least in 6-7 cases. Hardly any do that, which is a very good business actually. They should do, but they have not done.
I think since the audio we have an issue, maybe we'll move to.
Now coming to, so basically what I'm saying in wholesale, it requires a latest technological processes in the company. In coming to retail, actually, we started retail about 4 years ago. There the technology plays a big role. As Pallav said, basically Pallavji said that we buy in pools. So where we have to do all these technological, and especially in unsecured loans, we have to use data analytics. We are using a lot of call centers. We are using all sorts of such things. So where the technology will play a role, because we can't reach each and every customer there. The loan amounts are small, sometimes 50,000, 1 lakh. So here I think the technology and fintech companies are going to play a big role. We are already dealing with them, employing them. So everywhere, naturally, technology in wholesale will be more process oriented, in retail it will be more data analytics. And certainly value enhancement is the key. Whether whosoever does it, whether NARC does or IDMC does or whatever, whichever ARC does, if you don't do that, you just try to recover the money, then you are not doing anything great which bank can't do.
So maybe one last question, and then we have some questions from the audience as well. So before I take that, maybe one last quick fire, rapid fire kind of a question. Bad banks are not new. It's not a new concept. It's been there in multiple countries with mixed responses. So what do you how do you think India is uniquely positioned to do something much better than the countries that didn't have a great run with bad banks? And how is it going to do better than the countries that already did well? Any order, maybe I'll start with Mr. Mohapatra on this and then take the turnaround and end with Abhijit.
Thank you, Jayaji. What I myself see, and there's a new concept in our country, but when I read about the bad banks across different geographies, what I have read is that most of these bad banks were created after Lehman Brothers crisis.
Yeah.
And these bad banks were basically created to take over the bad assets from the banks so that they can keep on doing their own business. And these specialized outfits will be basically resolving that. But it was, most of these bad banks were created with a specific purpose and a specific period. It was not a permanent entity which was created.
Correct.
And most of these bad banks were basically created by the government. And some of these bad banks were successful, and some of the bad banks created by the government were not that successful. Now, and in all the geographies, one common factor was that there was only one entity. There were not two entities.
Yeah.
So the time will tell that when we have created this, that what will be the outcome of this. And I'm quite sure I'm a person with a positive mindset that this will definitely help in resolving, or I will say addressing a lot of issues which the economy is facing on the stress asset side. So that is my take on the bad bank as compared to the bad banks across the globe.
Mr. Bansal?
Yeah, so implementation is the key here. The other issue I would say, we have struggled as ARC in some cases where banks transferred initially. So the pertinent question is, how do we resolve this case and what type of assets are being transferred at what price? Now, as I said, if you're transferring junk and even if the price is 10%, you can't recover even 10% because we have seen in IBC some cases you can't get even 5%. But that doesn't mean that the system is at fault. What to understand is what you are transferring. So if you are transferring incomplete power plants, they are going to go into liquidation only. So you can't blame NARCL for that. So the first thing is that. The second thing is what price. I mean, we have seen some of the banks initially selling even at 100 cents while the cases were 5-year-old. But those, you can't recover 100, then you can recover only 10% maybe. So if you are transferring at right price, I think, as I understand, the price is being fixed at about 10% today,
Right.
which I just understand that it's not final. So if you are transferring at 10%, the assets are good. And if you work on these assets, certainly it will be a success. Now, if I see the example in Spain and some of the countries where the real estate was the main issue, so the assets were good. So you could resolve them. In USA, in trouble asset relief program, the assets were all good because mainly they were again loans to housing loans. They could recover money, and in fact, Treasury made some money. But you take the example of China, they transferred this like India, like us, and I mean some bad assets, very bad assets. And then today, China government is struggling to infuse a lot of money in that ARC or whatever you call it, bad bank, to keep it. Otherwise, there is a risk of default by that company. So I think it's a question of the price and the type of assets.
Thank you.
Abhijit can add to, he has more experience than me in this area.
They're all hands.
There we are talking to two ARC CEOs and two ex-bankers.
Yes.
I'm just a consultant who takes things from one and passes on to the other. No, so yeah, international experiences as
what you're taking and what you're transferring. The quality of what you're taking in, as Mr. Bansal said, as the good quality of assets means better resolution. So good insights from A goes to B is always a good thing.
Sorry, just to add here, let us see in IBC which assets gave us good value. 5 steel companies and 1 cement plant.
Correct.
So they were all good assets. Right? Sorry, Avijay, continue, please.
No. So just doing a comparison of how does the Indian model compare with global model. One issue is that everywhere globally, bad bank have had good people. And I think it's extremely important that we have very good resolution professionals. And I don't mean IRPs by that. I mean resolution professionals, people who have the ability to turn around assets. And it's extremely important that people think out of the box. Now, there are the nearest model that we have of success is the Malaysian model. And in Malaysia, they had similar issues like India. Disparate industries, they came out of the Asian crisis. Disparate industries, owner-managed businesses. But in 5 years, they managed to give the government a very good IRR. Their model was that the government funded and took over those assets. There was a right price established at which the assets were acquired. And then those assets, so irrespective of level of provisioning, fair valuation of assets was done. A price was paid for it. And then that was held as a KPI for the resolution team to turn around and give a return. So extremely important that we have that element in our, as both my co-panelists have said, that the devil is in the implementation. So that implementation has to be strong enough to say, firstly, that we have valued the assets correctly, irrespective of who funds it, in my opinion, but at least valued correctly. Once the valuation is correct, and that valuation has to be based on a proposed turnaround plan. If there is no proposed turnaround plan, then it's a sale of assets, as simple as that. But once you have a turnaround plan, then the debt management team has to be held responsible for turning around those assets within the time, basically putting the money where the mouth is.
Yep.
And that has worked very well in Malaysia. Now, compared to other locations where we were running cyclical NPS, so the US was primarily mortgages. And mortgages is a cyclical business. It got it got built out of over leveraging. And with that leveraging, what really happened is that everything which was AA became junk, but was acquired at junk value. And then when the housing cycle turned with prosperity, is when the recoveries happened. So it was an easier recovery for mortgage-based assets. So US, Europe, Iceland, these were all where they had agencies, it was there. But the nearest comparable, China is not comparable because ARCs in China are, frankly, as Raghuram Rajan says, asset dumping grounds. So we should not compare those. But if you look at Malaysia, I think Malaysia is the nearest example. We need to make sure that this NARCL or any other ARC for that matter, and ARCs do that actually, they buy values at the fair value and then have a turnaround strategy. So I think that model works for us well if you are able to implement it well and if you are able to have the right capital backing it.
Yeah, very important. Thank you very much. We discussed a number of very interesting paradigms and concepts, most in terms of garbage in, garbage out. So quality of assets really matters a lot. And what's the price that's transferred in? We spoke about what's going to be different in terms of aggregation, in terms of decision making being more focused and concentrated. We spoke about governance. We spoke about technology interventions. We spoke about the focus on increasing our enterprise value. And most important, the bad banks need to have good people. And that's when the turnaround can really happen. So thank you very much for it. We have a question. We have a couple of questions that we thought we would take. Mr. Muralidharan, could we have your video on?
Yeah,
so that you can ask the question directly to the panelists.
Yeah. At the outset, let me thank my panelists for giving us a lot of very actual and practical input regarding this ARC concepts. Sir, I would like to place my question like this. As such, we are all aware that ARC by per se has certain inherent issues like taxation front, there is timing of taxable income and tax rate applicability is still on card. Similarly, in case of capitalization, you're all well aware of the paucity of capital. Okay, that could have been driven away from this new ARC concept, but resolution mechanism, pooling of loan asset price expectation, and as well as the litigation issues, this is still on. How does this new NRC is going to tide over this, according to you? Anyone can take it.
So, Mr. Vasudevan, one is that the NARCL is like any other ARC.
Correct.
It is going to face all the issues that a current ARC faces.
Precisely.
Which is taxation arbitrage, as you rightly said, which is litigation risk, etc. And while litigation, the biggest issue we face is the lethargy of the banks to sell assets at the right time to ARCs.
Yeah.
If you can ask Mr. Bansal or now Mr. Mahapatra, they will tell you that the assets that come to them come after they are, reasonably tested by banks. We're looking at NARCL like that today. Say, oh, banks have tried for 5 years and now let's see what the NARCL can do. NARCL has no magic wand. Nobody does. So ideally, the problems will remain the same. But I think systemically things will change for ARCs because even the RBI's thinking seems to be moving from ARCs being a enforcement agency for security, which was formed under SARFAESI, to an asset resolution platform. And as we move to an asset resolution platform, I think you will see a lot of economic change happening. So, for example, you will have larger capital being attracted towards ARCs to fund assets. And as more capital comes, the cost of funding goes down. And as the cost of funding goes down, the bid offer goes up. That is maths. Now, I will tell you, the biggest arbitrage that exists is in AIFs. And Mr. Bansal will know that AIFs, by the way, if they invest in an ARC structure through SRs, it's counted as business income, and hence it is not passed through for them. So while pass-through income is charged at a much lower capital gains tax, if they are regarded as business income, they get charged the maximum marginal tax rate. So any which way it is not efficient. FIIs get taxed at 5%, which is not available to ARCs. So investment in SRs. So technically, I think more capital will get attracted to SRs, and once we get rid of these tax arbitrages, and RBI is pretty conscious of it, I can tell you, and there will be more recommendations coming that way to figure out that more and more capital can come in with ease to actually fund assets. But the condition to that will be that banks have to sell assets to the ARCs on a timely basis.
Yeah.
They cannot sell assets to an ARC after they have exhausted every means at their disposal, because then the asset has already rusted and lost value. It's a combination of
bringing a patient in on when he's intubated into the hospital.
Absolutely.
Did you have one more question, Mr. Muralidharan?
Or unless Bansal Saab and Mr. Mahapatra.
I was waiting for them to say. But one good takeaway, which Mr. Bansal told me, is absolutely correct. At what price and what time is absolutely the key of success of this ARC. And similarly, he said, bad bank with good people. So these are the good things just having, because most of the time we have found that timing is not right everywhere, because there are their own issues. Because in the rightly, as the bank said, Mr. Mahapatra Sahab can easily advent with that for us to get one what we call decision in the bank itself will take months. To do or not to do.
So I will a little bit disagree on this. It depends on the individual. If the individual strongly believes there is the time value in money, and he believes in taking the decision.
Absolutely. Unless the belief is instilled.
If you take a decision, there is a 50% probability your decision will be correct. If you don't take a decision, there is a 0% probability your decision will be correct. Now the question is, if everyone keeps on thinking, what will be the future impact of my today's decision? It is better to go to home and rest. They are not fit to be in the banking system.
Absolutely. Agreed. Absolutely. Absolutely correct. Thank you, sir.
Thank you very much. It was a pleasure having the eminent panelists, and thank you very much for your time.
Thank you.
I look forward to staying connected. Thank you.
Thank you, sir. Thank you, ma'am. Thank you.
Thank you, Vijay.
Thank you, Mr. R.K. Bansal, Mr. Abhijit Diwanji, and Mr. Palam.
Thank you, sir. It was a really interesting one. Thank you.
Yes, that was a very interesting discussion. Thank you, Jaya, for all that that moderation. This was very good session that we had. Looking forward to more such sessions in the future. Thank you, everyone. Towards the end of the session, I'd like to tell everyone the recording of this particular conference will be available on ICC's YouTube page and also on the website of the Banking Summit very soon. Stay connected with us on our social media platforms as well. Once again, thank you all the panelists and all the moderators, committee members. Thanks a lot.
Thank you.
अब मैं देखूं साफ बारिश के बाद हट गई रुकावटें राहों से आज ओ अंधेरा दूर हुआ हुई नजरें साफ जीत का विश्वास हर दिन
ट्रांसपोर्ट फाइनेंस, जैसी आपकी जरूरतें वैसी हमारी फाइनेंस सेवाएं।
मंजिल मिली है जिसकी थी तलाश, जीत का विश्वास हर इंसान।
श्रीराम ट्रांसपोर्ट फाइनेंस, विश्वास जीत का।